Welcome you all to the third day back to basic education series on income tax. Today's session is going to be on chargeability, deductions, disallowances under business or profession, presumptive taxation, and important case laws under the head income from business or profession with the relevant sections. And I came here to sit with you all and listen to the 3-hour lecture, and I am given the great honor of introducing my two very good friends who are going to be speakers for the day. Let me introduce Shri C.A. Venkatramanan, the Principal Associate at Lakshmi Kumaran and Sridharan, Chennai, working with the firm since April 2018. Lakshmi Kumaran and Sridharan is a full-service law firm practicing in the areas of taxation, international trade, intellectual property rights and corporate laws. The firm has its presence in 11 states in India to provide the best comprehensive services to all major clients. B. Venkatramanan is a chartered accountant having more than 5 years of experience in tax advisory and litigation. Venkatramanan is presently part of the tax team, direct and indirect tax in the Chennai practice vertical, and is specializing in transaction-based advisory on various aspects of the taxation law, assisting clients during investigations and providing litigation strategies to clients. Further, Venkatramanan regularly represents clients before the tax authorities up to the level of commercial appeals, authorities for advance ruling and tribunals. He has also authored articles and taken lectures on varied industry-wide issues in both direct and indirect taxes. He is a regular speaker in the Institute of Chartered Accountants of India. Welcome, Mr. Venkatramanan. We are very eager to listen to you. Can I have a big round of applause for him? Just not to interrupt in between, let me continuously introduce the second speaker of the day. Bharathi Krishnaprasad is a chartered accountant and is presently associated with Lakshmi Kumaran and Sridharan since 2015. She has previously worked as a corporate banker with a leading private sector bank in India. Bharathi focuses on direct taxes and foreign exchange laws. She advises clients on broad range of issues relating to domestic and international taxation. She also handles complaints and litigation up to the stage of tribunals. She is also a qualified company secretary and a cost and works accountant. Besides, she has also completed all 3 levels of the examination conducted by the CFA Institute USA. Welcome, Bharathi. Like all of us here, we are very eager to listen to you. Let's make use of the best opportunity today to clear all our doubts. Always human mind is better than AI.
That is created by human brain.
Exactly.
AI is created by human brain.
Very good evening to one of this. It's always a pleasure for us to come to SIRC and be it a speaker or attending sessions. It's always a pleasure to be here. Now today the topic that we are going to discuss for the next 2.5 hours is on profits and gains for business or profession. Now before we begin, let me say that this is a huge topic in itself, with vast judicial precedents, that even if we are going to sit here for the next 1 week, 3 hours each, we would probably covering only 50 to 60% of the whole topic as such. So what we have attempted here is to give you a broad overview of principles in general and touch upon certain provisions that may have much relevance during our tax audit that we are going to do in the coming months. Now, as you are aware that the Income Tax Act charging section is section 4. The income are divided into 5 heads. PCBP, profits or gains for business or profession, is the 3rd head. Now, when we all do audits or when we help a client in preparing ITR, what we do is we prepare P&L. We take profit as per P&L as the base. Then we make certain additions, we make certain disallowances, then we arrive at what is called taxable profits or gains for business or profession as per the IP Act. Now why do we do that? We do that because while in general, whatever accounting principles that you are adopting in preparing your financial statements are accepted, if you are using a mercantile system of accounting, which predominantly all of us do, that is acceptable to prepare your statement for the purposes of taxes also. The Income Tax Act provides for certain specific deductions and provides that certain deductions will not be given to you, notwithstanding the fact that that could have been debited to your P&L account. This is how the Act is structured, and that is why when we prepare, we disallow certain items, we allow certain expenditures, and we arrive at a taxable income. So whenever we are carrying out this exercise of finding out what is the taxable income under the head TGBP, we are required to be mindful of what are all the expenses that may be allowed, even though it may not be debited to P&L account. What are the expenditures that will not be allowed under the Income Tax Act? And finally arrive at taxable income. So this is how the whole Act is structured. One thing we should also keep in mind is when we look at an expenditure or an income, in most of the cases we may be required to identify whether it constitutes capital or revenue in nature. Why that distinction assumes relevance is because capital expenditure are in general not allowed as a deduction in the year in which you incur. In some instances, you may be able to capitalize it as a depreciable asset and claim depreciation thereon. Sometimes you may be able to claim that expenditure across a number of years depending on the particular facts and circumstances of the case. In some cases, you may not be able to claim that as a deduction at all. Similar is the case with capital receipts. In general, the principle that emerges from a catena of decisions is that unless and otherwise the Act specifically says that a capital receipt is taxable, then the principle is that it may not be taxable. So that exercise also we are required to carry out. Now, having said that, I now request Venkat to take you through in detail the overview of the provisions relating to computation of income under the head TGBP.
Thank you, Bharathi. So, when we look at the Income Tax Act, section starting from 28 to 44 TP is a complete code in itself for you to determine as to what should be the quantum of your income which is subject to tax under the head income from business or profession. So these are you just bucketed into the various provisions within the list of these provisions. Like 28 deals with the basis of charge, you have specific provisions for certain specific deductions. You have a specific section for a general deductions. You have provisions which talk about what expenses you are not allowed for claiming as a deduction, and you have these concepts called presumptive taxation. So this is how the entirety of these provisions are bucketed in the Act. Now, moving further, if you look at the charging provision for the purpose of this head, it says what is chargeable to taxes, profits and gains from business or profession. So the charge which is created is not on the income from business or profession. The phraseology employed is profits and gains. So whatever you make as whatever you receive as income in the course of carrying on of business is not, the entirety of it is not subject to tax. The net result of your business operations, whether it could be whatever is the profit, that is what is subject to income tax. So considering the fact that the phraseology employed is the charge is on profits and gains, so that's why when a few minutes back when Bharathi was discussing on what is the differentiation between revenue expenditure versus capital expenditure assumes relevance, because when you have to determine what is your true profit as per your methodology of accounting, we usually don't take into account the capex which we incur during a particular year. Though we might consider it as part of a depreciation, that might be considered for the purpose of determining what is your true profit, but generally the entirety of the cost will not be considered by us. Similarly, there will be certain aspects like losses, provisions, etc. All these things which we create, though there is no actual outgo of it, we will also have to take that into account while computing your true profit. So that is why, if you look at the Income Tax Act, you have certain specific provisions for in the manner in which an expenditure reduction can be made. Say, provisions relating to from 30 to 36. It talks about expenditure in the nature of interest, the discount on issuance of zero coupon bonds, rents, rates and taxes. And you have section 37 which talks about in general what are all the expenditure which you can claim it as a deduction which are otherwise not capital in nature. But if you look at the Act very carefully, you will not find any specific provision which specifically deals with the case which allows you to claim deduction for the losses. Right from 28 to 44dB, which I was referring to, none of these provisions will specifically deal with the case as to how should you claim deduction for the losses. Why? You don't need a specific provision for it. As I was talking a few minutes back, the charge is on profits and gains. So naturally, while computing your true profit, you will take into account whatever of the losses which you have incurred in the course of carrying on your business while computing your true profits. Similarly, you take the case of provisions. You have a specific provision for bad debts, specific section for bad debts, which will say provision for bad debts can be claimed. It's specific to banks but not for other associates, but not in general for all provisions. Like you have a specific provision for gratuity, section for gratuity, which talks about when can a provision for gratuity be claimed. But there are only certain cases where the sections deal with when a provision can be claimed as a deduction. But still, you have court rulings which say that if there is a provision for an ascertained liability, you can still consider it for the purpose of determining your true profit. Why? Because the charge is again on the profits and gains. It is not on the income earned. Had the phraseology employed been income earned, then naturally you would not have gotten any deduction for it. Since the phraseology employed is profits and gains, you naturally take into account all the provisions, losses, etc. which you incur because of carrying out a business while computing your true business profit. So, in this slide, just briefly capture as to how, where in these cases, though you don't have a specific section dealing with how these have to be dealt with, but the charging section in section 28(1) is itself wide enough to account for all these aspects while determining what is your true profit. Now we'll just deal with these concepts one by one. When it comes to losses, does it mean that any and every loss which you incur as a part of your business can be claimed as a deduction while computing your true profit? Say for example, today you run a factory, suddenly there's an earthquake or something of that sort, factory gets destroyed. There is a loss. There is a depletion of the wealth or the property which the business is owning. Can we say during that year in which the factory is devastated, is destroyed, can that loss be treated as a deduction, claimed as a deduction while computing your business profit? We would be happy if the session is also more interactive. So, if anyone can answer this question, it would be more grateful so that we can take it up from there also. I will also be giving the answer for this question as well. So, as to how in each case the loss should be determined or what is the basis in which you can account for the losses. But generally, can you claim deduction for all losses which you incur in the course of a business, or is there something called only these kinds of losses can be taken into account? Any thoughts on this?
When we are running a business, the normal losses we can claim. If anything abnormal losses or suspicious or something, according to the opinion, it cannot be claimed.
Okay. See, the courts have consistently held this principle that any losses which is capital in nature is not allowable as deduction, but any loss which is on revenue account, which you incur in the course of carrying on your business, can be claimed. So, now I've just set it out in very simple terms, but what is capital versus revenue? It's itself $1 million question. It is very fact specific, but to give to give a perspective to it, let's take this case of this Bharathi Krishnaprasad, the Supreme Court judgment, which essentially pointed out how can the deduction for losses be claimed. There they said that the earlier 1922 Act, the charging section was 10(1) that said profits means it should be the profits determined after allowing for the losses. But they said there that the facts of those cases where there was a selling agent business, they would have been entrusted to through a power of attorney, and A would have appointed some other person B to run this business. In the course of his exercise of his power of attorney, he would have carried on the business of A, but he would have misappropriated the funds. There the court held the power of attorney given to the other person was while in the course of his carrying on of his business. During the execution of this power of attorney, he has misappropriated the funds. that is something which is incidental in nature. But in the very same judgment, the courts continue to give an example. Say for example, you have earned profits and that profits have come to you and there is some kind of wealth which is created by the business. And later on, though if there is any theft happening or your factory gets destroyed due to some earth or fire or something of that sort. Though in essence a businessman has lost his property, but that is not a loss which has been incurred while carrying on your business. The loss should be incurred while carrying on your business. It should not be a loss where, irrespective of whether you carry on your business or not, if that loss is still coming to you, that is not a loss which is on revenue account, that is a loss which is on capital account. The Supreme Court would have given a very simple example. They would have said, say for example, you have run your business, you have earned some profits, you have taken back that profits back to your home. During that course of time, a thief comes, steals your profit. That is not a loss which is incurred in the course of your business. That is a loss which has come to you after your business has been run. Irrespective of it, these are profits which are bound to be lost, irrespective of whether you carry your business or not. That is a loss on capital account. That is not a loss on revenue account. That was the kind of, in simple terms, the Supreme Court would have laid down the proposition back then. So, in every case, while we evaluate of the facts and circumstances, once we find something, there is something called a loss that has been incurred by a business entity, we should not blindly consider it for the purpose of deduction. We'll have to just see as to how this loss had come into effect in the first place. Is it like a destruction of a fixed asset? Then naturally it's a loss of the property of the business, so it's not a loss which is incurred in the course of business. So we'll have to identify as to what is the reason for this loss and then determine whether a deduction for this can be claimed or not. You come to the next case of this Madras High Court, in the case of Quantum Wind Energy India Private Limited. There was a case where the assessee would have purchased the fixed assets using a foreign currency loan. Naturally, while making the repayment, you are bound to incur some forex losses. Court said this losses, though it is incurred as part of the business, the loan was initially taken for acquiring a fixed asset, which is a capital in nature. So since this loss is relatable to that acquisition, you cannot claim it as a deduction. Now you have the provisions of section 43A which allows you to consider this losses as part of your cost of acquisition while determining your block depreciation, etc. But back then when this provision was not there, courts have consistently held that this is a loss on capital account, you cannot claim it as a deduction when computing your profits and gains, which is subject to tax. Another interesting aspect when it comes to this losses is this loan write-off. You get between sister concerns, between business partners, there is this custom of extending loans to one another to help them bail them out from some emergency, for some business exigencies. Because you might have deep interest in their businesses, you tend to extend loan. Sometimes because of the relationship, you will also be okay with not recovering that loan in that sense, because you might ask them to waive off you might be okay with waiving off the loan. Instead of, had it been some other third party, you might have insisted upon getting that loan repayment back. But in some cases, especially in the context of subsidies, etc., you might be okay with waiving off your loan. Now in these cases, when you extend loan to bail out your subsidiary for its losses, or to help your subsidiary in terms of this financial crunch, etc., and because of which there is an irrecoverability of that loan which has been extended, a question which would arise as to whether can this loss be considered as an eligible deduction while computing your business profits. Again, there are two sides to this same issue, because there is one line of cases wherein high courts have held that you and subsidiary are essentially one and the same, in the sense that you have deep interest in the business of the subsidiary and you have invested in the subsidiary as part of your business. So any loss which is incurred by the subsidiary as a result of your any loss which happens in the erosion of your investment in the subsidiary is part and parcel of your business, you can claim it as a deduction. But this is nothing but a investment in the subsidiary is at best a separate source. You might have a separate source of income for you. See, for example, you are into the business of, say, manufacture and sale of automobiles. and your subsidiary is into the manufacture and sale of automobile components of these automobiles, and you have extended a loan to them and you are not able to recover that from them. Your business, your source which is giving you the profits is different. This loan is a separate investment at best. It is a separate source. So now to say that that source is like part of this business and then say that you can claim it as a deduction is not like logically speaking or even from a legal perspective. Though for your accounting purposes you might account that in your P&L and then determine your true profit. But from a pure legal standpoint, that is not emanating from your actual source of carrying on your business. It is from a different source. You determine whether that particular source is a business source or is it an investment source, then is it capital in nature, that is a separate question altogether. But that clause cannot definitely be offset while computing your profits for the source in which you are essentially running the business on. So that's where you have the other line of cases, especially in the cases of deduction of losses, wherein you take the case of that Motiram Nandaram Supreme Court. So there, what would have happened is, there would have been a person X who would want to get an agency business. So for the purpose of getting an agency business, you would have invested some 5 lakhs to this principal as a security deposit, which is returnable upon the termination of the agency. For whatever reasons, the 5 lakhs would not have been payable back to him, it would have gone irrecoverable. Supreme Court said that is nothing but a temporary investment which you have made for even entering into the business. That is more like a capital investment which you have done. It's an erosion of capital. That is not a loss on revenue account, that is a loss on capital account. Similarly, when you bail out a subsidy, that is an investment, separate investment, capital investment you have made. And because of that investment, there is an erosion in the value of the investment. That is not a loss which you have incurred in the carrying out of business, because you are not otherwise in the course of investing in many companies and then helping them out, etc. Your business is otherwise different. You have invested in subsidy because you want to expand, that is fine. But that's a separate investment in nature. It's an erosion of your wealth, which is of your capital investment, which is your capital account. It cannot definitely be construed as a loss in revenue account. So again, though there are favorable decisions to support the view that loans given, write-off of loans, loss on account of loan write-off given to subsidiaries is allowable as a deduction, but the going by the first principles and also by the past cases, we feel that it would be very difficult to account, to claim a deduction for those losses while computing your true business profits.
Okay, one question. So if the relationship between the parties, the lender and is so integrated, let's say either it is a forward integration or a backward integration, I do have a constant business with that particular entity. Now, is this a relationship in the context in which I am lending a loan? See, if that particular entity which is supplying a products to me, if I am not able to pay, then there could be a lack of supply to me in my own, which I use it in my production. In that case, if my business is so interlinked, because I have given a loan in furtherance of my business. Say for example, if I don't lend it, my the entity's production may drop, because of which he will not be in a position to supply the products to me, which I will use it further in my production. If this were to be the background, then
see, I get it. So there is a.
Sir, here I want to substantiate. Because in the normal course of business, whether it is a related company, whether it is a subsidiary company, if you are giving advance towards supply of goods, if loss is incurred, it is allowed.
That's what I am saying.
In the normal course of business, if you give any advance towards supply of goods, it is allowed as an expenditure. It cannot be denied.
No, I am not talking about the advance. I am talking about the loan which has been given to bail out the subsidy. So, advance, I am with you on the very same point.
Of business towards supply of goods.
See, advance is different, sir. Advance is more like the cost which you are paying for making the purchase. So, tomorrow he doesn't repay it. So, that is naturally, it is part and parcel of your business. So, that will be a business loss. I am not on that point. My example is on a very different point. It is like my subsidiary is dying. I am extending loan to him, bailing out from his financial condition. That is not equivalent to the advance given for purchases. So there is a difference in the example in which you are citing and the example in which I gave. So it's all fact specific. So you will have to analyze each and every fact. Now coming to your case, Krishna, I feel that though there might be some kind of there is some deep, business integration there. But what I feel is at the end of the day, the loan which you have given to him, like at the end of the day, the subsidiary or me are two separate entities. Like at the end of the day, like it is not my business or he is not my extended arm, anything of that sort. I am.
He is your extended arm.
Then in that case, then the theory of them being two separate persons becomes.
So you are looking at, see, I am saying from a commercial standpoint, you are looking at from a tax standpoint. From tax standpoint, subsidy and parent are two different things. But you look at as a group, right? Okay, I have a forward integration in such a manner. Whatever materials that he manufactures will become my raw material. For him, it may be an end product, but for me, it is a raw material, which I will use it for furtherance of my business. In that context, if that particular entity is not surviving, then it affects my business.
Like,
Sir, he is talking about the investment. Any advance in the normal course of business is
No, I'm
allowed.
not.
he is not an advance.
He is talking about.
No, taxation is also different.
I'm not no.
Ah,
So let's say, for example, I may require further goods. I may go for an expansion. I may require additional supply from the supplier. So therefore, I am giving a loan. Okay, you go and set up, expand your line so that you are able to produce the product and supply it to me. So later on, that business goes for a toss, and then I take this loss, subsumes the loss.
Yes, I just slightly modify the example. Instead of a loan, assuming the subsidiary needs money and then you make it as an equity investment. How will your, see, I feel, in my own, if I am right, according to you, in your example, that's a business loss which can be claimed as a.
I am only asking a question.
No.
I am not.
It cannot be allowed.
No, this point is that he is making investment to expand his business.
No.
I have given a loan to
Loan.
the entity.
Okay,
The entity will use the loan to invest in plant and machinery or expand.
So it is making an investment, it is loan in the form of investment only, no long-term only, no. It is not going to get recorded immediately, it is going to put it as a loan.
See, like, in my personal opinion, though there is a forward integration or a backward integration, I see it more from a perspective of an additional investment which I have made in the subsidiary in the form of a loan, which I have not gotten back. Because had I done it through a capital route wherein I made an equity investment and there is not recovery of it, that is definitely a capital in nature irrespective of how, irrespective of whether I recover or not. Similarly, just because I have given a loan to bail him out, to help him grow in that business so that I can survive, though my investment there is to make sure that I will have to survive. I see it as a separate source of capital investment there, though it being in the nature of a loan, and since there is an erosion there, I see it as a capital loss and not as a revenue loss.
Then it is the regular or recurring nature of the expenses. This is the first example you put the Supreme Court judgment. It is a misappropriation funds to BOE, but it is a negligence on the part of the company. No, so somebody has to verify that misappropriation the payment expense. It's a negligence part of it. Is it allowable as a deduction?
There, it's not a negligence. I have given him the authority to run my business on your account. So as a part of that authority, like he has
Misappropriation. So, misappropriation, if you allow like that, no, then everybody will do like this, then will claim it as expenditure. No?
So you are actually losing out the money.
That agreed.
Your profits have never come. See, you have given him the authority to carry on your business. In the course of that authority, some profits have to come to you. That didn't come to you. So you have lost that profits. So it's a business loss, right?
To give a parallel, since here's this money, let us say you are manufacturing a product and it has to go through 10 different steps. Fifth step, something had to be put in. Let's say it's a bike or some product, some particular product, tool has to be fixed to the product. That stage is missed. The product goes good, but the product is defective. You cannot use that. You cannot sell it in the market. You have lost
You would have incorporated it, some output would have come, you cannot do anything with it, you should destroy it. A lot of components would have gone into it, which is also negligence only. But that cost will be claimed as deduction.
In the normal course of business, why the losses are allowing in income tax? Because in the normal course of business, anything will happen. So the case which has been put, use it as an judgment in the Supreme Court judgment, I agree on that. But according to my view is that it's a misappropriation that means some person. It is a negligence on part of the person. It means there is no proper control mechanism for that organization. That's a misappropriation somebody else. So that has been given as a allowance as expenditure, allowance as expenditure.
It's not about what is inevitable or not. You are talking about normal loss versus abnormal loss. That is not the case here. Even an abnormal loss can be claimed as a reduction, provided while you undertake your business, you incur that loss. That is, say for example, you into a manufacturing process. Normally that process will entail a 2%. No, I'm just saying, because of some negligence, instead of a 2% wastage, it becomes a 10% wastage. Even that 10% wastage, you can claim it as a reduction. Why? Because it has happened while you undertake your business. It is not about whose negligence or whether it is inevitable or not, whether it could have been avoided or not avoided. It is not about that case. Whether that loss was incurred or suffered by you while you do your business. Then, if the answer is yes, you can claim it as a reduction while computing your business profits. See, the next interesting issue which in my opinion is this concept called deferred revenue expenditure. If you look at section 37 of the income tax act, that will say that you can claim reduction for the expenditure in the year in which it is incurred. Say, but there are this concept like you say for example you have you are kind of issuing debentures with a premium, wherein you have given the option of redeeming those debentures at a premium. For a 100 rupees worth debenture, you will redeem it at 120, say after a period of 5 years. That 20 rupees of excess is an expenditure no doubt. But when that will be allowed as a deduction? Do you have an option to prorate it over the period of tenure of debentures, or can you claim it only in the year in which the debentures are redeemed? Because that's when you actually incur the liability to pay that 20 rupees. In the year one, you might know for a matter of fact, ascertain that 20 rupees there will be an outflow, but nonetheless you will incur the liability to pay only in the year of reduction. And that be the case, do you have an option to prorate that expenditure over the period of 5 years? In my example, the life of the deposit is 5 years. Do you have an option? Yes, the courts have held this though, as per section 37, expenditure is required to be claimed. The expenditure is required to be claimed only in the period in which it has been incurred. But since this, especially there are certain deviations that are possible to this principle, especially in these kind of cases where you know for a matter of fact this expenditure is relatable to more than one period, then you have the option to prorate it, to claim a proportionate deduction over the period to which the expenditure relates to. Similarly is with the case for discount on issuance of bonds. 100 rupees worth bond you have issued at a discount of say 95. So you have gotten only 95, but you are required to pay 100 at the time of redemption. So that 5 rupees you can split it over the period of the instrument and then claim it as a proportionate deduction. But there is one tribunal judgment which has said that claiming a pro rata reduction is an option available. If the assessee wants to claim it upfront itself, that is also possible because that is strictly in accordance with the law. Pro rata deduction is more like a judge-made law where the courts have consistently held that you can claim. But even if the assessee feels in the year in which it has been incurred, they can claim. The tribunals have held that in the year of incurrence, you can claim it as a deduction. So this concept called deferred revenue expenditure is only applicable for expenditures which you know for a matter of fact for to be certain that it is relatable to more than one period. But you can't take this logic to these advertisement expenditures because you do not have control over the benefit that will accrue to you. You have incurred that expenditure in year one. Maybe that benefit you might reap for 10 years or so, but you do not have control over the benefits. In that case, you cannot say, I expect the benefit to come to me over a period of 15 years, I will prorate it over the period of 15 years, because you don't have control over the benefit. Unlike in these cases of premium on redemption or discount on issue, where you know for a matter of fact, for these 5 periods is what I am giving you the benefit. Say for example your ESOP discounts which are being given to your employees. You know for a matter of fact for these whatever is the period of service for which the ESOPs have been given, that is the period for which this ESOPs are being issued, so you can claim it as a deduction. So this concept of deferred revenue is there, inbuilt, more like a judgment law, which is there in the income tax law. It is not completely gone, though it might be an accounting principle. It is still relevant in some cases in income tax law.
Pre-production and revenue expenditure can be written up based on the policy of the company. They have to decide whether to write up in 3 years or in 5 years. Pre-production revenue expenditures, which cannot be capitalized directly.
Sorry, I don't get your example.
This deferred revenue expenditure I am talking, sir. Any pre-production expenditure, revenue expenditure incurred, which cannot be directly capitalized to a particular asset, can be written off as a deferred revenue expenditure based on the company's policy. Company has to decide in how many years it has to be written off. Maybe in 3 years, maybe in 5 years, maybe in 7 years.
That is slightly different, sir. That is not a deferred revenue.
That is a deferred revenue expenditure only, sir.
No, in the past, if you defer, people have deferred some of the expenditure. While I think accounting standard initially permitted how
before starting the commercial production, whatever revenue expenditure which you are incurring, which cannot be directly attributed to the capital asset, that is deferred revenue expenditure only.
That may be deferred revenue for the purpose of accounts, sir.
No, for income tax also. The company has to decide in how many years it has to be written off.
That is accounting.
That is accounting. That is not income tax, sir. Because income tax you have this specific provisions of
It is allowed in the normal course of business. We don't know what is your experience and what you are talking.
When we say the company can decide, when there is a company accounting policy, recognition of income or expenditure, he is working about it. It is there in income tax or not.
we need to see the facts. Unless he gives the facts clear, we can't answer the question.
Is there any more commercial production?
Yeah, any revenue expenditure income can be written off, can be claimed as an expenditure, not in 1 year.
Okay, sir.
Is referring to 35B.
That preliminary expenditure. That is because of that provision you are claiming.
That is actually limited.
Yeah.
But the list of items.
That is very.
35B is very limited.
Very limited. And maybe.
So to answer this point, any expenditure that is incurred after a business is set up, before the commencement, you can claim it if it is a revenue expenditure under 37 itself. But if something is incurred before the business is set up, you may have to see whether you can capitalize it as part of 35D and claim it over the period of 5 years. Or if something is not classifiable as part of 35D,
then there is a difficulty.
at some cost.
Then it's a some cost.
Even term loan interest is also there. Probably after 1 year you will start repaying, but the production, it takes 2 years or 3 years for him to operationalize and to take the commercial production. Till such time, whatever interest he is paying, it has to be capitalized and it should be treated as a deferred revenue only.
So under the Act, possibly it may answer the question. It may not be treated as a deferred, sir. Either you claim it in the respective years. You don't have to defer it.
You have not started your commercial operation at all, sir.
So, if commercial operation is slightly different from business setup, sir. If business setup is there, then any expenditure after you incur after the business setup, you can claim it as a revenue expenditure.
What is your stand on this interest till the commercial production?
Which interest, sir?
Term loan interest for 3 years he is paying.
You will have to calculate as part of your project cost. So you will have to say me what is the fact pattern, sir. You give me one liner and then you ask me the question, it's very difficult for me to answer.
Go.
Term loan interest are generally capitalizable as part of your project cost. And there is a specific section called 35D, as Prasanna was pointing out.
Yes.
You look at that provision, there is only specific set of expenditure that can be claimed. So moving there on. So these are with respect to losses and expenses. So then now, yeah.
What about huge advertisement expenditures? Advertisement expenditure. Suppose with respect to new product, something new project.
Yeah.
When you have to claim that as quantum is not relevant.
Quantum is not relevant. You
That
can.
is not the criteria. If otherwise, it qualifies as revenue. Advertisement expenditure, naturally, whatever you are doing, it's going to help you for more number. It may help, it may not help also. You may have no idea about it. But as just because the quantum is huge, so that it may not mean that it is capital in nature or cannot be claimed as a
So deferred concept will not apply to that. That's what he said.
Yeah, it will not apply because you do not have control over the benefit that will reap to you. That will reap to you as a result of it.
Only research.
That's what.
See, in case of a debenture, you have a 20-year-old debenture. 100 rupees is the face value, 120 is your deduction. 20 rupees is the interest cost. In effect, it's the cost that you are bearing for using that money for 20 years. Therefore, we call it a deferred revenue. That entire 20 is not relatable to 1 year. It is for using that money for 20 years.
If you write off that advertisement expenditure over 3 years or 5 years, department will be happy.
That's what that's kind is that okay?
But currently accounting standards will not permit.
Yeah, that is also there. Your accounting standards don't permit.
No, given the paradigm shift in the accounting standards, what does the Income Tax Act really
Income Tax Act has been
no
structured.
more, I'm talking of way forward.
So
Is it going to have a shift or it's going to continue the same way?
Income Tax Act as such contains certain provisions where certain deductions are allowable across a period. Those remain.
I fully agree and no debate on it. The way forward I'm asking, is there going to be any shift or it's going to be the same? This is going to take great. I'm just asking because no, since you are in touch with the department, I'm just asking from
We don't anticipate such a change right now, big change right now. There's no
Wait
real
like this for quite some time more.
In these direct export, they have tried the concept of deferred revenues, but unfortunately, it has never seen the light of day.
that's the precise thing I just wanted to ask. Probably after June.
We have just got the tax accounting standards.
Sir, in the case of foreign exchange, average rate, they talked about average rate in the accounting standard. It is very difficult to prove the department. We have to account based on the customs invoice and we have to credit based on the amount what we are receiving on the date of receipt. The question of average rate will not apply at all. That is what our accounting standard says. Average rate.
Correct, sir. So, moving on to the income side of it. So, we have dealt with the expenditure side till now, losses, provisions, and the deferred revenue expenditure. Now, again, the income side of it has some interesting aspects like, see, there are certain incomes which are capable of qualifying under more than one head. Say, take the case of a property letting scenario. You have a specific provision called for house property income, where you own a house property, you give it on rent, whatever rental income you earn from that is subject to tax under the head income from house property. But take a case where your bread and butter is to do this as a venture, like you develop properties and give it out on rent, or you acquire properties, give it out on rent, either for residential purposes or commercial purposes. So now there might be a doubt as to whether can this qualify to be the nature of a business income or not. Though, in essence, if you look at the house property chapter, you can fit it into that very specific head. Now, when you do it as a business, it can also qualify as a business income because what is taxed under section 28 is profits and gains. So now, whatever is the rent received minus your expenditures, etc., will be taxed. What is net result is a profit from your business of letting. So there is no harm treating it to be a business income as well, because The benefit of treating it to a business income is you get more deductions when compared to the house property chapter. But now, is it a very clear-cut scenario where when you are into the business of letting out property and earning rent, it is a sure shot case of a business income, or is it only if you will have to tax it only at the head house property? Though you have Supreme Court judgments, you have High Court judgments, all these judgments have divergent views. Now, seeing in my screen, the first two are the Supreme Court judgments, which have said, when in terms of your memorandum of association, if your object is to acquire properties and earn income by letting out the same, it will be treated as business income. But in the past, there have been Supreme Court judgments, especially in the old income tax law, that said, when there is a specific provision dealing with house property income, which says when you as an owner of a property, you earn an income from that property, then that should fall under the specific head, though it is capable of falling under the head income from business or profession. Though you have Supreme Court judgment in favor, you also have a Supreme Court judgment against you also, because that East India Housing and Development Trust Limited, which said that it should be taxed as house property income, in that case also the assessee was formed with the object of developing and setting up markets. There was no quarrel with the MOA. His object was to set up markets and give out stalls on rent and earn income, rental income from it. But still the Supreme Court said in that case, that this judgment is in the context of 1922 Act, it's a property income, you will have to tax it under the head income from property and not income from business. This Chennai Properties and Investments is a recent judgment, which the Supreme Court said, saying since the letting out is done as a part of a business, it should be treated as business income. So, like, in tax, there is a famous saying, there is no one single view for a particular issue. You always have two views. At the end of the day, it all matters as to how do you convince the judge before you as to which view is going to accept that. So, this issue is a classic example for it.
This will always lead to litigations because the tenant who is paying you the rent is going to deduct tax under 194
Yeah.
And 26As will tell it is a income from house property, and you are going to show it as business income. You can be ready to receive notices.
Yeah.
So some of us might have already received some, and we have to depend on all these judgments, and it's pretty much difficult such situations.
In the case of Chennai Properties, the main object itself is letting out. So it is naturally it is a business.
The predominant portion of the
No,
activity.
even in East India Housing also the predominant object was.
But it is very old judgment you are saying. But now the emerging things,
We don't know.
people are looking into that aspect.
In Chennai Properties,
Predominant activity they are doing.
we might disregard certain judgments are being old. We don't know when. See, at the end of the day, if tomorrow someone goes and says East India was never considered in Chennai Properties, it's no surprise the Supreme Court can reverse the Chennai Properties judgments. There have been judgments on that side also.
So
If you look at the new judgment of this new noble society, it reversed a very long-standing concept of this predominant object list for the purpose of this education institutions claiming exemption. It's been a age-old proposition, like for 50, 60 years it's been followed. Supreme Court reversed it in one go. You can disregard certain judgments as being old. We don't know when that will come to the light of the Supreme Court and they can get into the question of again delving into the matter.
one that if it is incidentally, it means an activity of renting of house property. If it is incidental, so it will be the rental fixed house property. If it is predominantly you are doing this activity like selling property, it should be business. Somewhere it is rule is saying incidentally doing some activity of the rental property, it will be in the house property.
These are like I've told you, like if you want me to answer this question, I don't have a clear-cut answer for this. If you say me it's income from house property, yes. If you say me it's income from business, yes. I will have to argue depending upon what the SSC wants. For the same SSC, I will have to argue income from house property, yes. For the another SSC, if I have to argue income from business, I will have to argue that. I will cite whatever judgment is in my favor. and pray that the department does not cite the other judgment against me. Moving into the aspect of the other issue in this, income capable of falling under multiple heads, this thing called share trading. So now the recent trend is everyone is kind of more interested in trading in shares, and none of us are kind of even interested in putting in FDs or PPFs, and especially income tax also is not giving us any kind of benefits, phasing out on this savings mentality, etc. So all of us will be more interested in the investment angle of the share trading. So again, this concept of the share trading is capable of, again, the income from the profits which you earn from the purchase and sale of shares. Whether is it an income under the head capital gains, whether it is an income under the head business or profession, has been a subject matter of debate for quite some time. Until in 2016, the department came out with this circular, because they understood, yes, there are many people who are doing this interesting business. Especially this circular is more beneficial for these retail investors, because we get to trade only in listed securities. So it says, if as an assessee I give an option that the stocks in which I trade is to be classified as a stock in trade, then don't disturb that. Treat those shares as stock in trade, and whatever income which you earn will be the business income. From the profit you make from the sale of shares will be your business profit. The losses you make will be your business losses. If there have been listed securities held for a period of more than 12 months and prior to the date of sale, and you have chosen the option to treat it as a capital asset, then again don't dispute it. Read that if he has treated it as a capital asset, then treat the income arising therefrom as a capital gain and not as a business income. Leave the choice to the assessee. But at the same time, this comes with a rider. The department says, if the assessee has chosen a purpose with the sole intention of doing some bogus transaction or gaining some indirect tax advantage, then question those assessees and accordingly classify based upon what was the intent of this purchase and sale, etc. There is a specific clarification in the circular. So I would say, especially for these individual returns, when we take the return filing, when it comes to, unlike property lending, when it comes to share trading, it's more kind of fairly settled, especially in the light of this circular, because the option is with the assessee. He has to choose whether he wants to treat it as a stock in trade or a capital asset. Depending on his option, now the things have become easier, just that you would have to ensure that the assessee does not have any kind of malignant intention to defraud the revenue. And there are some high net worth individuals who have, or if there is a trading in this unlisted securities, etc., which is not covered by this circular, then you will have to rely upon the past precedents. Those say that what is the intent for you to purchase and sell these shares, whether it is your intent to earn profit or gain out of it, or you want to treat it as an investment income, you will have to prove some evidences to support your intent, and depending upon it, share trading will be treated as business income or profits and gains. But this is only for the income emanating from the sale of purchase and sale of shares. The dividends, etc., will continue to be taxed under the head other sources, because that's a very specific provision. Though, given the kind of tangent in which Chennai properties and property lending set, there also it was a house property. It was let out with the purpose of earning income and then making a profit out of it. If you take the similar argument, one can also extend that logic to dividend income, saying, if I want to treat this investment as my entire sole activity is to invest in companies and earn dividend out of it, that's my business, right? Then one can take an argument that it's a business income, but given the fact that dividends is explicitly occurring in income from other sources, it would kind of be a very debatable position, because you don't have a case law supporting that, because even these circulars, which have said that somewhere also hint to the aspect that dividends are done with the investment mindset and not with the mindset of doing a business activity. So when that circular is clarifying that kind of position, then naturally dividend will have to fall back to income from other sources. It cannot come to business income. Though that argument is remotely possible, it would be kind of very prone to litigation.
With regard to the dividend point, at least in a set of contexts, the courts have accepted that proposition that although it is taxed under IFOS because of an explicit provision in 56(2), but when it comes to carry forward of, let's say for example, you have a carry forward loss, not the current year loss, carry forward loss, but you have a dividend income during the year. When it comes to set off, there the courts have accepted that proposition. Your business is into investments and have a capital appreciation plus earning a dividend. So therefore, although it is a business income, but for 56(2), it is a business income. Because of that, it is taxed under other sources, but under the set off, they have accepted that proposition.
Yeah. Okay.
Sir, I think in case of share trading, as is dealing with future and option, that should be concerned PG only. I don't know the exact sector at all. If we receive salary also, we have to classify in PG.
Yeah,
future and option.
that's a speculative transaction loss. That will come. See, here it is talking about the basic listed shares which
speculative. Only intraday will be classified as
speculative. That came by a clarification in 2014 also. Before that, it was still speculative. That came by a clarification. If you look at the definition of speculative transaction.
And also there might be some situations where, okay, let me give it as an example. I am an individual, I have ₹1 crore, right? I want to do share trading, but I am not aware of how to do it. So I give it to a portfolio management company, I tell them I will give you 1 crore. You do only share trading and mutual fund, but get me 12% interest. So how do I declare it? Do I declare it as income or business operation, or will I declare it as a capital gain on shares at the end of the day?
If the transactions are take place in your demat account, you are responsible.
I am talking of fix of income.
Yeah, see, at the end of the day, you will be trading in your name only, right? So you will have to declare. You decide you want to treat it as a capital investment or a stock exchange. You give that option, then accordingly you treat it. So that's all, because this circular is kind of, in my opinion, beneficial, especially for retail investors like us, because we have the option now, the ball is in our court. Unlike before that, the department had to decide.
Can the position be changed from year to year?
No, sir. Then the whole purpose of you given that option is lost.
That's why I'm saying the state circular consistently should.
Yeah.
The only thing is that the assessee decides to treat income. So you can treat as capital gain, or you can treat as
Yeah.
So can we include two different securities, one as a stock and the other
Yeah.
as a fixed income?
You can have two portfolios, separate portfolios. That is up to you. So it's 2007 circular. So the next thing about this income capable of falling under two heads is interest income. So I would request Bharathi to handle this.
Now, as far as interest is concerned, if you are otherwise into the business of lending, then it's a very straightforward answer, because interest is your main income, main activity is lending, and therefore interest should be taxable as profits or gains. If you are a manufacturer or trader and you have some surplus money and you are investing it somewhere, then that interest goes into the bucket of income from other sources. Quite simple and straightforward. One nuanced aspect with respect to interest occurs when that interest can be treated as inextricably linked to your main activity. Now, what do we mean by inextricably linked? Now, let us say that your client is starting a new project just incorporated a company, now setting up a factory. Now in the course of setting up his factory, he has to import some machinery from outside India. Now we would have all seen that some bankers will say that you place a 10% FD, 20% FD. Only then I will give you an LC. That FD will have some interest. Now you are engaging a contractor to do this activity. He is asking you to give him a huge sum of advance. You don't want that advance to be without interest, therefore you say, you give me some interest on this advance. So you get interest from that FD also, interest from that advance also. Now, this interest is not generated out of a voluntary act on your part of placing any surplus money with the objective of earning an income. You earned income, incidental. You ask the contractor to pay interest because he is asking you a huge sum, you want him to be serious about it. Therefore you say this money cannot be free, you give me an interest. You had to give that FD to the banker because only then he will give you an LC and you can bring that machinery to India. In these situations, this interest, even though it is an income generated from an act of so-called placing money somewhere, this interest is inextricably linked to your main activity that you are carrying out. Now, Supreme Court says that in this scenario, this interest will not be separately taxable, rather it will be considered as capital in nature. It will go and reduce your cost. Your project cost is 100 crores, interest is 1 crore, now it will be 99 crores. Take another scenario, same client setting up a factory, borrows money, that entire money is not immediately required. He thought that he will have to give. Contractor says you give me 50 crores, but then something happened. That 50 crores you don't immediately need, but you have taken it from the bank. You have to pay interest to the bank, but money is not immediately required. You decide, why should I keep this money idle? Let me put it under an FD, let me get some 1 month interest. That interest, even though you have not commenced your activity, you have just incorporated. Factory is under construction, business not started. Even though you have not commenced, that interest will still be taxable because that is not considered to be linked closely to your project, that has come as a result of a conscious decision on your part to voluntarily go and place the money in deposits or somewhere else so that you want that interest so that the money does not go waste. Here, the interest will be taxable as income from other sources, notwithstanding the fact that you have not commenced any activity. You are still not even on day zero, you are still reaching there. So the first proposition that we told was held by the Supreme Court in Bharathi of Steel, that the Supreme Court said that if it is closely linked to your activity, then that will be capital in nature. It will go to reduce your costs. Department cannot separately tax. The second proposition that we told was decided in duty called Halpini, where again similar fact, just that it was a conscious act on part of the assessee to place it as fixed deposits. So, in the context of interest also, we may have to run through this test. Now, business could have started, company could have been doing operations. In the course of normal carrying out activity also, something you would have to buy from outside India, you may have to give a LC, you may have to place an FD for that interest is closely linked to your business. That will also come with an habit of GDP. So, as far as interest is concerned, broadly, even though the principle could be straightforward and simple, we may have to be cognizant of these specific small things when we are determining how the interest has to be offered to tax. Now, subsidies. Now I think as individuals, all of us, most of us are putting that solar plant because government is giving that subsidy. Even my father is doing that. In general context of business, lot of subsidies are given, lot of grants are given by government or different other state government, central government, some other associations to enable the SSC to either set up his business, expand his business or run his business smoothly. Now, for us to understand how subsidy has to be taxed, it will also be interesting to know what was the position of law right from the beginning. Now, before 2015, which amendment we will be discussing in just a while, the taxability of subsidies depended on the purpose for which it was given. Now, if that subsidy is directly related to acquiring a capital asset, government says 100 crore you are buying this particular machinery, I will give you 20%. 20% will be my contribution. You come, you set up this factory in India, you manufacture. There, section 43, which defines actual cost. Now, actual cost for the purposes of determining what is the amount on which you will have to claim depreciation. For determining actual cost, the provision said that if you are getting any amount from somebody for the purpose of this, buying this asset, it could be subsidy or some other third party could be financing a portion of your cost, that amount you will reduce it from your cost of acquisition. Fairly simple. 100 crores is my cost. Somebody is giving me 20 crores, could be subsidy, could be anything. My effective cost is only 80 crores. 80 crores is my actual cost. On that I will get depreciation, end of the matter. Suppose that you are setting up a particular project. The government is giving you some amount. The amount could be determined based on the taxes that you have paid. The amount could be determined based on some other factor. The code says that you don't have to see how the subsidy was arranged, how the grant was determined. The grant could be determined based on refunding your taxes. The grant could say that this much percent of your power cost I will give you, this much percent of whatever expenditure that you are incurring I will give you. Does not matter how the grant is calculated. You have to see what is the purpose of that grant. If that purpose of that grant is for you to smoothly run your business so that some portion of the costs you are saving, then that grant will be revenue in nature. But if the purpose of the grant is for you to set up a business, is for you to expand your business, then the purpose of the grant will be capital. Revenue grants will be taxable, capital grants will not be taxable. In some cases, capital grants, because of explanation 10 to section 43, may have to be reduced from the cost of the asset and you will be entitled to claim depreciation only on the net cost. So this was the position before Finance Act 2015, where the court predominantly said, listen, don't look at how the grant is calculated, how it is given to you, that is not relevant. You will have to see the whole scheme. You have to see how this grant was conceived, what was the purpose, why is it being given to you. You look at the purpose. If the purpose meets this test of augmenting your capital, then call it capital. Otherwise, if the purpose is to tide over your costs, is to help you operate at significantly lesser costs so that you are left with more profits, then that is revenue nature. Now, what happened post Finance Act 2015? There was a specific amendment that was brought into the Act, wherein the amendment said that any assistance, be it in the form of a subsidy, incentive, concession, reimbursement given by the government, whatever you call it, it will be treated as income, except in a scenario where you are reducing it from the cost of the asset because there is explanation 10 in section 43. In all other cases, it will be treated as income. Is what this amendment says. Now, the question is, what about all those cases that were there before the amendment, which said that the purpose has to be seen, you have to see whether it is capital or revenue? Those arguments, we'll have to still see if that arguments can be put forth, nothing wrong in doing that. But there could be, according to us, it could be difficult because now a specific provision has been brought and all along we have been saying that if something is capital in nature, unless it is specifically made taxable, it is not taxable. Going by that principle, department will surely contend that earlier you said so, now see I have gotten a specific provision, don't come and tell me this grant is capital, this grant is revenue. Whatever be the grant, you have to pay tax. Either if it is related to a depreciable asset, go reduce it against the cost, otherwise I will happily claim tax from you. So that is the position that emerges after Finance Act 2000.
Just adding to the point which Bharathi said, this specific provision was challenged in Bombay High Court in the case of Serum Institute, saying that this is kind of completely overriding the concept of capital versus revenue in nature, and the earlier principles which said how should one see capital versus revenue, etc. will become redundant. But the court said this has been a specific provision which has been brought in, and especially in the context of tax law, the discretion is with the government as to how they want to tax, what they want to tax, etc. Now, since the specific provision has been brought in, you have been given the luxury or the benefit of reducing the subsidy if it is a capital investment from the cost of asset. If you are not able to do that, pay taxes on the subsidy. Because in any which case, even if you reduce it from the cost of your asset, by way of, you will be claiming a reduced depreciation. So, somewhere the intent of the government is they don't want to just give the subsidy and ask you, don't want to, and not recover the taxes from you for that subsidy. They also want you to suffer the tax component for that subsidy as well. So, considering the same, the court said this provision is completely valid and cannot be struck down. This appeal before the Supreme Court is still pending. We just have to wait and see as to what happens before the Supreme Court.
There was also section 145B which was brought in, which said that if you are receiving a subsidy, if you have not offered it to tax in earlier year, then it will be deemed to be income of that particular year in which you have received. Now, separate income computation and disclosure standards also deals with it. Yes, please.
On the previous point on subsidy, there is a subsidy which is, the reason for subsidy is capital investment. We have set up a new plant. So, the mechanism of giving subsidy is 10 years of state GST being waived. Right, so this point I understood. So now this after this 2015 point says considered as income charge. But what will be the timing of how do you accrue it or when do you take it to?
What does your scheme say?
Scheme says so based on my sales I have to pay 18% GST. The 9% GST will be a waived off.
So you will know how much you are eligible only at the end of the year.
Right.
That is how it is. Then it accrues only at that particular time.
So every year that portion of subsidy will be taxed. So even if it is a waiver, if it's a waiver, I am not going to account for it. I am going to account for the 9% of GST alone, right? That 9% is accounted for.
No, you collect 18%. You will collect 18% and pay only 9%.
Right. So
you will not collect 9 and then debit only 9. You will collect 18 and only debit 9.
Because the government is given us.
No, you have the luxury to collect 18 and pay only 9. Then there is no benefit for you.
You cannot hold the money. Collect it from the public, how can you hold the money?
You can, there will be some specific provisions which will even incentivize. The budgetary support scheme in Uttarakhand, which came after GST, allowed you to do that. That's how indirect taxes subsidies work for all along. Because there is no concept of subsidy for you. Because you don't collect, there is no income for you. You pay 90, you get 9 from the customer, you pay 9 to the government. It's as good as collecting 18 from the customer and paying 18 to the government. You will benefit out of it.
But that will be after input tax credit adjustment.
This budgetary support, etc., how that works is, they will either refund you the cash portion which you pay, or they will refund you the entirety of the amount. That is a very state-specific thing. So, whatever you collect from the customer, and what you don't pay to the government, what you retain it, that will be your subsidiary, especially in these budgetary support cases. And that point in time, every year, once you, so the subsidy will be accruing on a year, month, at the time of every sale you make.
Right.
So, in line with 145B, whatever you retain as a benefit, that should be offered for tax.
Right, but so that is after input tax credit adjustment.
See, that depends upon the scheme, that's what I'm saying. Because I have seen schemes where you will be given the, say for example, you collect 18 and the net amount you pay to the government is only 3.
Correct.
You will be refunded only 3. In some schemes, you collect 18, you will be refunded 18 also. So, it all depends on how the scheme is working. So, there, unless I know the scheme, I will not be in a position to tell you what is the subsidy.
Earlier there was a scheme in SIRC where you can collect the GST and retain. After 10 years you start repaying to the government. That and all we have to show it as a liability only.
Yeah, that's a deferred scheme. So that is not a subsidy in this sense. That's a deferred scheme. That's not a subsidy. That's not even income in the first place.
So now you do have a specific ICBS or grant where it specifically says you can't postpone the income beyond the receipt.
Year of receipt, you're right.
Right. Say for example, if the grant is subject to some conditions, although they are given the money upfront, but it is subject to some condition. Should I wait till the condition be satisfied? Let's say for example, the year of receipt is different from year of satisfying all the conditions. Let's say satisfying the conditions is subsequent to the receipt. Will I be taxed upfront? Because it says you cannot postpone the revenue beyond the receipt as per ICDs.
You're right, even 145B says that. It says that the year of receipt you have to offer it to tax if you have not offered it to tax before, and ICDs also has a specific line. It says that you cannot postpone it beyond the year of receipt.
No, whatever he is talking, after the fulfillment of the condition only, that can be treated as an income, otherwise it will be withdrawn. Till such time we have to show it as a liability only. It cannot be treated as an income.
So
each subsidy has got a class. There is a undernoted classes you have to fulfill in 5 years or in 6 years. After that only you are entitled to enjoy. Till such time, otherwise it will be withdrawn. Till such time we have to show it as a liability only, not as an income.
So there can be difficulty in that proposition, sir, because of the specific question. Whatever you are saying, I completely agree that but for this provision, I would have taken the same stand. Now that this provision is there, according to me, there can be a difficulty.
So tomorrow, let's say for example, I don't satisfy any of the condition and they take back the grant. So then the question is, how do I claim it as a deduction? Should I claim it under 28 as a loss?
You can claim it under 28. But for this provision, sir, one could have taken a stand that the income itself did not accrue. Therefore, I will not offer it to tax in this year. I might have received it, but I have received it, I am holding it. I am not completely entitled to it. It is not my own money. I don't have 100% hold over it. I have to fulfill certain conditions. Only then this becomes entirely at my disposal. Now I may be able to use it. But at some point in time, if I don't fulfill the condition, I will have to get money from somewhere and give him back.
There is a specific accounting standard for accounting of government grants.
What is for accounts will not be true for tax purposes.
Even for accounting is relevant for tax purpose, sir.
Not always, sir.
No, sir. We have seen many cases. We have come across and we have won.
Sir, unfortunately, there is also a specific standard from ICDS on grant where they use this matrix similar to 144B. That is where the issue is coming. There they say you can't postpone it beyond the receipt. They want to tax everything upfront.
That is why I said, sir, but for this provision, sir, you are generally, if this provision was not there, what you are doing in accounts should equally apply to tax, because your argument will be you will be following mercantile system. You would have said that this income does not accrue to me. Therefore, what I have received it is in the nature of something probably like an advance. Therefore, it will be like a liability and I will pay tax only when I am completely entitled to it, when I am satisfying all conditions. But here they have specifically brought in a provision. Therefore, when computing our income for the purpose of income tax, we will have to keep that accounting aside. This is one such circumstance where income tax is deviating from your normal accounting practice.
Accounting has to marry with income tax. In section that you don't take depreciation as per the
Yes, sir. Accounting is the basis to arrive at the net profit, taxable income. Department cannot teach you how to account.
Sir, you are completely right. In fact, the provision in income tax 145 says that you compute your income based on your normal accounting.
Normally accounting principle.
That will stay. That will remain. That will remain. Your normal accounting principles are valid and completely accepted till something else is there in the income tax. Something else is there in the income tax. That will be right.
You cannot force your accounting.
No, to arrive at the net profit, the company law says how you are supposed to account.
There is a specific provision in the law, which is a variance. Then you cannot.
Should sit with CBDT and advise them to draft tax laws, even by your expectation accounting.
That's why there are so many issues, sir. Otherwise,
if accounting has to manage income tax, then you will not be sitting.
Then ICDS may not have come out. You don't need it.
TDS but area
It is part of the law.
this new emerging concept of carbon credits, where I am more conscious about the environment. I incorporate all those processes that result in lower emissions. Then, under the UN guidelines, I could be entitled for some carbon credits, which I can also sell and make some money. Earlier, there was no specific provision to say how it should be taxed. The courts in some of the cases said that this carbon credit, receipt from carbon credit is a capital receipt, therefore it is not taxable. You are not doing anything. You're getting it, you're doing some process, you're getting it, it is emerging out of your consciousness for the environment. This is the language that is used, and therefore it is not revenue in nature and it is capital in nature. No need to pay tax on that. The tax makers saw this and then realized that unless I'm going to put in some provision, this issue will go on for a long time, people will not pay tax. So let me incorporate a new provision. That's why 123 BBG came into the act, which said a 10% tax on transfer of carbon credits. You don't get any deduction for expenditure, right? You don't get any deduction for expenditure. You earn any income from transfer of carbon credits, straightforward 10% tax. The section is not stating anything on which head you will offer it to tax. It only says tax rate is 10%. You arrive at total income is 50 lakhs, 10 lakhs is carbon credit, on that you pay 10% tax, balance 40 lakhs you pay whatever tax you want as per the other provisions of the act.
Can you pay down capital receipt?
Yes, that doesn't matter.
So expenditure is absolutely
Yes.
out of control.
No expenditure will be allowed. I will also read out.
So long when you receive capital receipts, you get a capital receipt, but still that tax will be 10%.
It's a special
It's a special provision.
So the purpose of buying this carbon credits is to encourage companies to ensure that they buy this. So the expenditure is not allowed, what is the incentive? Just try to understand.
No. You will get the deduction only for cost of acquisition. Whatever you see.
So you get capital in nature.
If you purchase it, you will get deduction for cost of acquisition, but you cannot get deduction for any other expenditure.
No, that's it. That's the only thing I can understand.
And one more thing, this carbon credit should be validated by this United Nations Framework Convention. That's very specific one, because there was one recent judgment wherein the carbon credits which SIRC sold was not validated by United Nations Framework Convention. So what the tribunal went on to hold in that situation is it is not covered by 115 GB. So sale of carbon credit is a capital receipt, so not taxable at all. But they didn't get into the question of whether it's taxable as capital gains, etc. But for the purpose of business income, they said it's a capital receipt and they stopped with that. But that's a catch there, because there are
some clause in 224.
A very good point.
You can say that it's not even entering in section 14. There's no head of
224 is an inclusive
Inclusive
definition.
definition.
Vishwas, in section not covers. 4C is any other.
Actually, very good point, sir. Any questions on what we have done so far? Now, this is another portion which I think how much ever we may discuss, there will always be some questions that will be looming large in the mind. This 28 clause 4, which prior to Finance Act 2023 said that value of any benefit or perquisite, whether convertible into money or not, arising from business or exercise of profession is taxable. What is benefit, what is perquisite, not defined here. In the context of profits or gains from business or profession. In the context of salary, one may have clarity on what a perquisite is about, but here it is not defined. Now, Supreme Court in Mahindra and Mahindra said that was in the context of waiver of loan. They said when the loan is waived, what is happening? That loan you got in the form of money only. When that is waived, you have more money in the hands. That benefit there is therefore in the form of cash. What is sought to be taxed under 28 clause 4 is not something which is in the form of cash. It is something other than in the form of cash. And there are other precedents also before Mahindra and Mahindra. Therefore, they said that 28.4 will not apply in case of waiver of loans because that benefit is in the form of cash itself. Therefore, not taxable. Then what happened? Finance Act 2023 amendment came. Now, there was a tedious provision called 194R which was also introduced, which said any benefit or perquisite in the course of business or profession deduct 10% tax. Now, I am loosely using the word deduct. It said deduct 10% tax or ensure that appropriate taxes paid to the government. Now, why this deduct and ensure? We will have relevance to these phrases used when we come to disallowances for non-deduction of tax and source. Deduct is because when you are giving something in the form of cash, there is a possibility to deduct. I have to give Venkat 100 rupees, I have to deduct 10 rupees, I will keep 10 rupees with myself, give Venkat 90, pay that 10 to the government. Suppose instead of giving Venkat 100 rupees, I give Venkat this laptop. Can I deduct something? No, because this is a non-monetary perquisite. Rather, I am giving something in kind. The law says ensure that appropriate tax is given to the government. Either I ask Venkat to give me, laptop value is 1 lakh, I ask Venkat to give me 10,000, pay that 10,000 to the government. Now tell Venkat, you pay 10,000 to the government, show me the challan. So I have to ensure. How I ensure is left to my prerogative. I do it or he does it and I ensure. Now law said that any benefit or perquisite which is given in the course of carrying on business or profession, 194 hours will apply 10% tax. Then they realized that, okay, 28.4 we have not amended. There the president says that only non-cash will be taxed. Now let us amend that also. Now 28.4 as it stands today will include cash, non-cash, whatever be the value of perquisite, whatever be the perquisite that is given in the course of business or profession, everything will be taxable. Definitely you can have problems in how to value it. Now as I said, in salary you may not have a problem because the definition of perquisite contains a list of items and it also says value of any other perquisite as may be contained in the rules. Rules will say A, B, C, D, E, F, G, H. Something other than A, B, C, D, G, F, G, H, we may say rule is not specified, not taxable. This is not one such scenario. There are no rules for valuation. There is in fact no definition for benefit of perquisite also. But whatever be the value of benefit of perquisite, you have to offer it to tax. There could be disputes on how to value it. Now recently, there was a case in the context of salary taxation where a lot of other things. The essential issue was about interest-free loans or concessional rate loans which are given to employees. The court in that case said any concessional rate loans or interest-free loans, there is a perquisite. It is a perquisite because you are letting him enjoy money at a lesser rate or at no cost at all. Therefore, he is able to enjoy that money and therefore you have put some benefit to him. You have given him some benefit that should be taxable. Now, this interest-free loans can be quite common in businesses where Director will give interest-free loan to the company, one company will give interest-free loan to the subsidiary company, subsidiary will give parent, all those things are common. Now, there definitely will be a question as to whether something has to be offered to tax in the hands of the company which is receiving that loan. According to us, this interest-free loan can definitely qualify as a perquisite. What is the value of the perquisite can be a question. You may say that, okay, yes.
What happens if, in the case of banking companies, when they give loans to their employees at the concessional rates? That fully should be taxed and TDS to be deducted, right?
That will be salary. That is separate.
Salary.
This 194R what we are talking about is what benefit you are giving in the course of business operations, not salary.
In the case of loan waivers,
sorry?
when we give loan to companies and we waive off or give it at a reduction rate, that time what will be the scenario?
Then give me a perquisite. I think there was some circular which said no need to comply with 194R for some one-time settlement. They never said it is not income. They said TDS provision need not be complied with.
Private banks and insurance companies, what they normally do is to encourage the quantum of sales that the agents make. Right? They take them on a trip, some exotic places. I can see some smiles around because how do they quantify this? They say you achieve this 300 crores of 30 crores of something, and there is a Goa trip where you will be taken by flight, accommodation, everything. Do we quantify? How do we quantify that? And is it coming under the perquisite per se?
They call it as business promotion, ma'am.
If you are organizing a,
can you call it a perquisite? Is my first question.
Ma'am, again I am saying there is no definition for benefit or perquisite. Now, if Venkat tells me that okay, you have done this, I will take you, I will sponsor a trip to Goa for achieving some target. Now I go there, I am not going there for business. There is no confidence. I am going there, I am spending time. Flight cost is borne, hotel cost is borne, food is borne, everything is borne, I come back. Definitely that will qualify as a benefit or perquisite. I don't think there is any way where one can escape from it. However, if you are saying that I am organizing a conference for my business partners, for all my agents, I am organizing a conference and it is in Goa. And they go there, they attend the conference, 3 days, it's only conference, it's learning, lectures, back to back, they come back. That may not be benefit of it. That may not be that will not be benefit of it. But if they go there, 2 days they attend conference, 3 days they go out. Then the 3 days becomes a problem.
They will call all the 5 days as conference.
The business conference is 5 days.
Sir, we do not know to what extent department can ask this question. That is the problem.
Why I specifically said because you are talking about the marriage between income tax and accounting. In accounting, all these expenses might be put as staff welfare expenses. No, if you are giving,
if that is for your employees, that's a different thing, ma'am. That is not covered by this particular provision. If it is for your dealers, let's say you are an automobile company, you have dealers. If you are organizing this for your dealers, it's a dealer conference, you are telling them new features about your car, you are telling them how to better their marketing techniques, then that's a different thing. If you say this much target you achieve, I will give you car, I will send you to this place, I will give you World Cup tickets, then that's completely different.
It could be a business promotion expenditure for the company which is incurring, but this is more from a recipient
point of view.
Someone who is enjoying that.
Correct, exactly.
So the thing is, TDS has to be deducted, no?
TDS has to be deducted.
So that's the company's liability then.
Yes.
So they have addressed this issue in 2 circles. The point which you have asked is also is one of the questions in the circular, where what they say is, if you are choosing any specific employees and then you are providing him a benefit which is not extended to uniform to all, then what you are choosing someone and extending the benefit, which could be a perquisite. And if it is entitled to everyone, then that may not be regarded as a benefit or perquisite. In one of the examples they have classified.
Free samples given to the doctors.
So this started because of the doctors itself. During the COVID period, promotion of medicines.
It is entirely March 27.
It is also a business promotion. Unless you give free sample, you will not prescribe your medicine.
You can cover it at any angle. Or if someone finds out.
Department view is restricted, sir. Their exposure is very limited. Whereas our exposure and the businessman's exposure is much more than the department's exposure. In many practical cases, I have seen.
We don't know how things are going to be going forward, sir. That is a scenario.
No, the problem here is how do we quantify and how do we value? That is the issue here. Even if you want to follow.
If I remember right, I think maybe Prasanna or Venkat can confirm. The circular says you consider the cost that you have incurred for valuation.
Multiple valuation is prescribed in that circular. Let's say if you have bought out a product and then you have given it, then the price at which you have purchased will be the value of Perquisite. But if you have manufactured, then the cost you do for manufacturing or the normal sales value you do, then that sale value will become a Perquisite, because that is a value at which normally you will sell it to any third party. The same thing will equally apply to
the larger point is that whoever is the recipient, he has to show this as income. The whole purpose of 194R is this only. See, lot of people are having lot of schemes, they will give gold coin. People will get gold coin, nothing will be known to the income tax department. But now, this 194R has to be compared, and in fact in some cases we are seeing that department has started asking, like GST department has started asking what are the schemes that you are running. So obviously there is interaction between multiple departments. So one department gets an information, other department knows it. It's not a case where the neighbors don't talk to each other. So now there is free flow of information.
Dealers are achieving beyond the target. They are given offer. They are given extra discount.
That is covered in the cost.
Cost is different, sir.
Usually people visit or
But how will they do? They quantify it also.
No, extra discount will be covered under the cost itself.
Correct.
It will be taken care in the cost.
Exactly.
No, after sales discount. I think that's what it is.
Volume discount.
Volume discount.
Volume discount earlier also you will specifically
Here we are talking
the
only about the
purchase cost.
purpose, it's not on.
It will be under 184R. Should I deduct TDS?
No, that is calibrated.
Normal course of business.
not required. 194R.
It is in the normal course of
If it is
business.
directly related to the purchase, then it is not required.
Yes. You need a perquisite.
Those scenarios specifically covered.
Quantities, what is the purchase, what is the percentage.
As far as showing it as income, then anyways there was no problem. Discounts were not a concern for the department also. The concern for the department is largely on this non-monetary
In terms
grants
of GST, that makes a big difference. And that also they ask us to pay the
Sir, we
GST.
cannot account at all. Buy two, take two free. Can you call it as a perquisite and you can deduct tax? It is all in the normal course. It is all in the normal course of business.
Sir, the circular has clarified, though it is a perquisite, you don't need to deduct TDS.
Circular does not say it is not a perquisite. Circular says it is a perquisite, but we know the difficulty for complying with 194R, you need not comply. That's what it says. So you had some questions?
GST.
No, any income is separately accounted in the P&L account. On the GST, they are insisting to be paid, unless it is proved that it is linked to the purchases. Any incentive receipt, everything they are trying to classify and they are trying to collect GST on that. So any incentive, they classify everything as incentive. Incentives comes under the classification of income for GST, and they ask us to pay 18% GST on that. For that purpose, it has to be linked clearly with the purchases. Any income received by your discounts.
So correct, sir, you will have, see, this entire provision is about the recipient who is receiving the benefit offers that to income. When it comes to discounts, etc., you offer it by way of a reduced purchase cost or a separate line item of income, department is least bothered. As long as that benefit is take root into your P&L, that is fine. This entirety of the provision was brought in to cater to the segment where
Invisible benefits.
ma'am was asking about the sponsored trips, gold coins. where it does not look to the P&L because trips are sponsored to the employees of your dealers. Neither the dealer accounts it as an income, they don't know who has enjoyed it. So for all these things, this provision was brought in. So now to make sure that the recipient shows as an income, they brought in the TDS provision. Because I deduct TDS, I'm duty bound to show. I have no other option. The important question that can arise here is, see, on one hand, yes, fine, I'm showing it as an income. At the end of the day, this ticket, say for example, the sponsored tickets, I'm giving it to my employees. Can I claim it as a deduction? Okay, just think of this scenario. Instead of giving him the sponsored ticket, I give that company 1 lakh cash. And then say you make sure that this 1 lakh is spent for the benefit of this employee. So this cash would have definitely been accounted as an income. This 1 lakh, when I spend it, is an expenditure. So now just because it is in kind, or because of this deeming provision, I am accounting it as an income. The assessees can take benefit of the fact that when I am expending it, because at the end of the day it is my employee, because for a company, corporate personality, they can't enjoy it on their own account. They will have to make sure that their employees enjoy it. So when they give it to their employees, can they claim it as a deduction? We feel that leeway we can take. It is not just about showing it as an income. You show it as an expenditure as well. But because of this, don't take a position that in which case I am going to claim it as a deduction. Why at all I will take it as an income at all in the first place? Because that will hit your TDS statement. So now you will be duty bound to show. If you are
given to the employee, it becomes a perquisite for the employee.
It is practically not possible, sir.
So from the recipient point of view, so if the recipient is going to see a 194R reduction in the 26 As, under what head is he supposed to declare this?
Business secretary.
Because the section itself will apply that the recipient is receiving it in the course of carrying on his business operation. Not otherwise.
So foreign travel received by a person carrying on business, is it going to be liable for GST also?
Either
foreign ticket or foreign travel received by some agent or a dealer by the company, and if it is accounted as an income under 194R, and is it going to be charged for GST?
Sir,
you account it in such a way it does not attract GST.
Because it has to be shown.
Sir, he is asking for a legal help, not an accounting help wherein we can escape the revenue.
See, any 194R gets credit in the P&L account, otherwise notice comes.
Sir, I will get your question. In this GST, now you tell me, just modify the example. Okay.
Simple foreign travel.
No. I understood your example. You have a scheme wherein you say to the dealer that
it is reimbursement of expenditure.
Sir, allow me to answer now. So you sell some X number of product and I give you some quantity discount. Okay. This you agree as part of your purchase, and this discount is not a separate consideration for something the dealer has done. It is part of the same transaction. I am offsetting against the sale. It's a composite contract, the essential transaction being the sale of the commodity. Similarly, these benefits, okay, if you can somehow structure in your agreement saying that why this sponsored tickets was given, instead of giving you a discount, I give you the sponsored tickets. Then you can say this as inextricably linked with your original sale transaction. Your bundling test will come, composite supply versus mixed supply. You can argue, now in the trade, there has been a genuine practice of the sales promotion teams not being done by way of discount, rather being given this kind of incentives. You can get into the concept of this natural bundling and the essential supply being the sale of goods. I have paid the tax on the sale of goods, I don't need to pay tax again. This is the argument which is possible you can take. But the department will not accept. I will give it in writing, the department will not accept. You will have to travel up to the higher level and then put forth your case. But this is a reasonable ground which you can take. See sir, things have become complicated. You can try whatever the means of accounting and then make sure that you can pray that the department doesn't find out. All we are pointing out is in a situation where if you come to fall within that 1%, where the luck is not in your hand, you get caught, what you should do. 99% of the cases where you escape, not an issue.
194 they specifically has there is a credit entry in the P&L. Just be correlated. If it's not, then immediately notice comes. So you have to.
So that's what I'm saying. I'm giving you an argument for you to make sure that you don't need to separately discharge GST on it. That's what I'm saying. You can specify to the department, put forth your argument saying it's nothing but a discount given in kind, not a discount given in cash. See, all these are arguments which we'll have to evolve. Okay, now these are concepts which are coming in some legislations. There are change amendments to the law. We are forced to change our accounting practices. Never in our history we would have even accounted for this non-monetary perquisites. This provision has is now forcing us to do it. You might be quiet. You will say I will not account it. What if your provider deducts tax? You will be naturally forced to account. You will otherwise get an intimation from 143(1). You can account it under soft welfare, business promotion, petty cash, whatever you want, name it, miscellaneous expenditure. Once your provider shows an investigative statement, you will have to automatically show it as an income. I am giving you ways where you can argue and make a case. In my opinion, I feel this composite contract is closely linked with this. 194R and GST has a very close linkage. One of the areas where income tax and GST have a very good interplay, in my opinion. This composite contracts situation you can bring in and then say it's a discount given in kind and then try and give an argument saying that it is part and parcel of the original sale transaction, no GST is paid. One more thing which we wanted to also stress upon is, one thing is this 28(4) being there, okay, saying that it should be an income. But one thing which kept us wondering as to whether, now there is a dealing fiction. Now irrespective of the fact that I receive a benefit of, once I receive a benefit of purpose, because of this dealing fiction, should I directly offer it to tax, or should I also see whether what I received as a benefit passes through the test of a capital receipt or a revenue receipt? The reason why this thing came to our mind is because earlier, before this provision, when you also have a separate dealing provisions for this duty drawbacks, etc. If you look at section 20, that will say any drawback which have received under the pursuance of foreign trade policy is an income. In the Delhi High Court, in the case of Maitan Power, they said in that case also the assessee was having this project inputs. Whatever was the excise duty and customs duties paid on procurements was claimed as a duty drawback benefit under the extant FTP policies. Delhi High Court said, you are setting up a project. Because of a foreign trade policy which has been promulgated for the purpose of exports, you are being given some benefits of tax incentive. This tax incentive is directly related to the setting up of your project. You should go down to reduce your project cost and it is capital in nature, despite there being a dealing fiction. Now, can you import that logic here? Now you say, you have this bank example which servers asked. I have obtained a loan from a bank for making a capital investment. Bank has waived the loan. Okay. If it is a benefit, yes, benefit, because bank has waived their right to get back the money. Can I take an argument saying this is for a capital transaction, it's on capital account, though there is a dealing fiction, this has to pass through the test of capital versus revenue, and since it is capital in nature, I need not offer to tax. Can I take a position? I feel going with the principle laid down by Delhi High Court, given the presidential value, that position is possible. Naturally, any position you take is disputable. What I am just giving you is a possibility that we can still take an argument. So, whenever you receive a benefit, just see whether it is on capital account or revenue account. If it is on capital account, especially this loan waivers, etc., try your luck in taking such arguments as well.
What is the Delhi High Court?
Maitan Power Limited, MAITHON Power Limited. That was in the context of duty drawback. Even for duty drawbacks, you have a similar provision under 28. If I am not wrong, it's 383. They said just because there is a dealing fiction, don't directly tax it. Since it is that incentive is for a capital account, it is a capital receipt, don't pay tax.
That can apply for subsidy also.
But subsidy, there is a change in the definition of subsidy. It is not it's not about how 28 is worded. It's about the definition of income in 224. They have defined subsidy in such a way that unless you reduce it from the cost, it is an income. So subsidy is very difficult. But for benefit of purpose, especially in these loan waivers, because loans we get it not only for working capital, we get it for capital investments, business expansion, etc.
For this loan waiver, we can take a stand that it's a capital receipt by nature, therefore we don't offer for tax. Is there any decided thing is there?
Loan waiver taken for working capital requirements is not a capital receipt. Loan taken for capital investments waived off, it's a capital receipt. Loan taken for working capital requirements is not a capital receipt. So purpose of the loan matters.
In certain times you take loan without specifying the nature. So in that case,
if you don't give the proper reasoning, then we feel there is a difficult problem.
important things. In time purpose, we will go back. Because we were discussing 194R and all that, in the same breath, we all know that if a particular transaction on which there is a liability to deduct tax and such tax is not deducted, and if deducted not paid to the government before your 139(1) due date of filing does not come, then that expense is not allowed as a deduction. This is something we all know. If the payment is made, if the payment is to a non-resident, then the entire sum is not allowed as a deduction. If the payment is to a resident, then 30% of that sum is not allowed as a deduction. That's what the provision says. Now, sometime back, we consciously said that the word deduct has to be carefully used, and it applies only in a scenario where you are giving a monetary amount and you are able to deduct from it, as the proper meaning of the word suggests. This tedious disallowance applies only in a scenario where you have to deduct tax and you have not deducted, or you have deducted not paid within 139(1) due date. Let us take 194R. 194R, some perquisite is given. Let's say some laptops are distributed as a perquisite. You have to deduct tax under 194R. You have purchased that laptop from somewhere, you are claiming that as an expense. You are giving it to your dealers, but you have not deducted under 194R. Now, do you think this disallowance of expenditure will get attracted?
Yes, because you are under non-compliant.
Non-compliant with?
194R.
Non-compliant with 194R. But what were you required to do under 194R?
It all depends where you are booking the expenditure.
I am booking it in my P&L, sir. I am calling it as some terminology I am using. I am booking it in my P&L. I am buying laptops from HP and I am giving it to my dealers. According to us, you can take a position that disallowance will not get attracted. The reason is, if you look at the language of 194R and the language employed in section 40, read it together. 194R will use two different phrases. One, deduct, second, insure. Deduct will apply in scenarios where the outflow is in the form of money, payable is in the form of money. Insure will apply in scenarios where the outflow is non-monetary. You cannot deduct, but what you have to do is insure. This 48 disallowance uses the word deduct. It does not say that disallowance will also get attracted in scenarios where you were required to ensure you have not insured. We are not saying this will not be questioned by department. We are not saying it will not be disputed, but we are saying that such a position can be adopted. Now, what happened was, when 194R was introduced, the penalty provision for non-deduction of tax did not contain this. So, we were speaking in seminars that you deduct under 194R, no penalty. We have been nothing, there is no consequence. The next finance act they amended. Therefore, you may escape disallowance for now, but it could be amended. But definitely, non-compliance under 194R will attract any other liabilities that will befall on you for non-deduction. Those things are there. But as far as disallowance is concerned, probably we can take a position that
the government has to know, having ensured that, okay, you are not elected.
you don't say it will be disallowed if I don't insure.
They are saying, you will be insured. The 194R, they are saying you have to insure.
So we will
Department cannot identify, sir. Unless we voluntarily declare.
For the argument, they will say, having elected, you say, no, I am not paying any tax, I give the product only. So you are not saying that I am not elected TDS. Then they have to question that, having ensured that whether the party has paid the TDS.
Sir, they may institute proceedings only for non-deduction under 194R. That you will have to face. There is no doubt on that. But
then will come into non-compliance here.
Can we ask the company to get into an extra?
You see the difference in the
that's what
wordings.
practically we. Sir, yeah. I'll just briefly read the provision.
Yeah.
Now, 194R says any person responsible for providing to a resident any business or perquisite, etc., shall, before providing such benefit or perquisite as the case may be, ensure that the tax has been deducted in respect of such perquisite at 10%. So, the proviso says, where the benefit or perquisite is wholly or in kind or partly in cash and partly in kind, but the part in cash is not sufficient to meet the liability for deduction, then the person responsible for providing the benefit shall, before releasing the benefit or perquisite, ensure the tax required to be deducted has been paid with the benefit. Now, your obligation is not to deduct. Your obligation is to ensure that the tax has been paid.
Then they should not release the gift itself.
Correct.
That's what they say.
So either you need to deduct and give, or you need to ensure before giving the things, he has to
I
comply.
completely agree with you. If you ask me, suppose I don't deduct, will the department say that you have not deducted, I will institute proceedings for non-deduction of tax? Definitely. They are right on that. If they say that you should have ensured, you are not ensured, how can you give that laptop? You should have taken the cash from him, or you should have paid it out of your own pocket, whatever it is you should have done. But if they say that you should have disallowed under 40A, then we are saying you can probably take an argument that disallowance will not get addressed. We are not saying giving free from litigation. Department will obviously give.
Point is that expenditure allowable. If
So you
company
don't see this achievability.
Section will say what is disallowed is 30% of any sum payable on which tax is deductible at source and such tax has not been deducted. There are also cases to say when they say sum payable, it has to be in the form of money. Any sum payable on which tax is deductible at source and such tax has not been deducted or after deduction has not been paid to the government on or before the 139 month.
payable.
Any sum payable to a resident.
Here is not going to make any difference to the product.
That's what he's saying, no disallowance.
That's why I'm saying we can probably take a position till such time that we are blessed with the same act. In the future also, we can probably take a position that for 194 are non-compliance. But I mean that's not a position that we can advise clients, because non-compliance with 194 will have other consequences. Somebody has not complied, they come to you. You will separately find 194 in proceedings initiation, but you can take a position that 40. But somebody comes and asks you, should I comply? Answer is definitely yes, you have to comply.
Because if you read the both line items, first is saying non-compliant, so no deduction. The next line it will say if we comply, then you will have no deduction. So that means something was
So for the
not
purpose
there.
of PPT, we have used a very loose language.
We can't put the legal language in PPT.
The words, amount, sum, all these words, they mean only cash payments. Money.
Well,
Is there, any
That's not
circular, is there any circular saying that it is only money and not, or it is money and also kind is included?
Then I remember there is an ITAT Bombay decision, red chilies.
In the context of 194J, any sum paid means only monetary.
Monetary.
payment.
I think there are one couple of other rulings also. This one.
So there is a contrary ruling in Kanchanjunga seafoods, where the payment was made in fish.
But
That is
sum
different.
agreed in money.
Because there it is different because that case is like this. I tell Venkat that you give me legal services for the opinion that you are giving me, I will give you 1 lakh. The agreed amount is in monetary terms. Then I tell Venkat, instead of giving you this 1 lakh, I will give you this laptop. It is not a case where I tell Venkat I will give you laptop for the services. I tell Venkat I will give him 1 lakh. In lieu of 1 lakh, I then tell him that instead of 1 lakh money, you take laptop. There the consideration is agreed in monetary terms, settled in non-monetary terms.
Even in sales tax, there is judgment called Devidas Gopal, Supreme Court. Because in sales tax is levied on sale made for a cash consideration. So there they would have laid out the law saying if the contract is denominated in money, though it might be settled in non-monetary terms, sales tax is payable. But if the contract is not denominated in money, but rather the consideration is completely non-monetary, then don't pay sales tax.
That is on sales tax.
So even in Kanchanjunga,
So another point I can argue is if you look at section 50B before the 2021 amendment, where the language used is sum of money
Slum sale.
in the context of slum sale. So there they said if you do an exchange of asset, I think Bharathi Krishnaprasad said it is not exigible to slum sale because it
Exchange
is
is
an
not
exchange.
covered, only sale is covered.
So that is why they have amended that definition of slum sale.
Because I think slum sale definition had a problem.
50B I guess.
Yes.
Correct.
Now, another issue is you have deducted, but you have not deducted the appropriate rate. Now, earlier there were a lot of disputes between 194C and 194J because 194C said 2%, J said 10%, 2% or 10% problem was there. They tried to resolve it by making one amendment in 194J, thereby creating a new problem where you have to now decide what is professional, what is technical, because professional service definition will include technical consultancy also, and technical service definition includes consultancy. So they probably felt now we have resolved the 2% 10% dispute between 194C and J. Yes, it is, but you have created a new dispute in 194J. Now, in that context, let us assume that you decided that tax has to be deducted at 2% under 194J, but department says no, boss, this is professional. How can you deduct at 2 if it is 10? There again, there are cases to say that only an act of non-deduction will attract disallowance under 40, but not an act of short deduction. If it's a mere case of not complying with the provision in a complete sense, then you are not going to be penalized by getting the expense disallowed. You will be penalized only if you have completely been negligent and not even complied 1% of it, and you have not deducted at all. So there are cases to say that in such cases, disallowance will not apply. Now, the next aspect is, suppose tax has not been deducted by the SSC and that's an admitted fact. There are no proceedings instituted on the SSC under 201. But in the assessment proceedings, disallowance is proposed. Can you take an argument that you have not considered me as an assessee in default as yet? Therefore, this disallowance should not be attracted. can the department, can an assessee take such a position? 201, the time limit for passing an order is for the resident it's 7 years from the end of the financial year which payment is made, or 2 years from the end of the year in which the collection statement is amended. And there is one case to say that you can apply this 2 years only in a scenario where your TDS return reflects this amount, not in any other case. Where it doesn't reflect this amount, you cannot apply this 2 years, you have to apply this 7 years. Suppose you have not been subject to proceedings under 201, can you take a position that you cannot be subject to disallowance under 40? And we are just raising this question. We also don't have clear-cut answers as yet. There was one case in Bombay Tribunal where this issue was briefly dealt, where the court said that another angle to it. I have paid some amount to somebody. I have not deducted TDS. Department says disallowance will attracted or 201 will be initiated, but they have not instituted any proceedings on that person. Ideally, it is his income. I was only required to deduct taxes. It is his income. He is not subject to any assessment. So can the department come behind this person without closing that loop also? So in that scenario also, can you take a position that 40A disallowance will not get attracted? According to us, no harm in taking that argument. We don't have enough precedents as yet to support, but definitely there is no harm. If you are confronted with a litigation, you are before the department, you have to argue, definitely we can take this argument.
Okay, so beyond that assessment to check that the 3 years offered, the 3 years didn't now.
That is already a provision is there where you are able to prove that he has offered it. If you have good rapport with that particular person, there are a lot of practical difficulties because they will ask you for the CA certificate saying that it has been shown in the written of income, tax has been paid and all. Practically there are difficulties, but you have, obviously if you are not meeting eye to eye with that person after your contract with him is over, then you can't do anything. Otherwise, if you have, then you will only be fastened with an interest liability. You won't be fastened with the liability for complete production. In that case, you will not have disallowance under 40 also. There is a provision to specifically say.
We talk about 190 procedure, case director only 2% instead of 10%. Whether the entire amount will be disallowed or
you won't have disallowance, sir. No disallowance, zero.
Allowances will be fully allowed.
Allowance will be full.
But differential taxes will be yes.
That will be under 201. Nothing under your assessment proceedings, nothing will happen. Normal assessment, you won't be facing any problem. The penalty in the form of disallowance is only in a case where there is a complete disregard to the TDS provision. Not in a case where you had a doubt, you thought legal interpretation 2% will fit and not 10%. In those cases, the department does not want to trouble you and then say that no, proportionately you will have to disallowance.
Practically what happens in the example which you are highlighting, right, the assessment of a company or a person happens first. Now that the timeline has been slashed, 201 proceedings, I still have a timeline because if you look at, there is no specific bar for filing the TDS returns. Even as long as the online system permits.
You can revise it for any number of years.
Any number of years. So therefore, the timeline of 2 years will come only after the last.
In fact, you are completely. In fact, that's why I said there is 7 years. In fact, that's why I specifically mentioned the time limit.
So therefore, there is no prerequisite that unless and until TDS proceedings have happened, then only the question of 40A 1 or 1A can come. Now it is practice happening other ways. There is a disallowance that happened in the assessment order, which has been used by the TDS officer to at least collect the.
You're right. I agree with you on that point. In fact, internally when we are discussing also, we just wanted to plant a thought as to whether such an argument can be raised. On the other hand,
the recipient cannot file the updated return if you revise after 5 years or if you deduct after 3 years. Complaint. What is the status? How to file the updated? If someone is deducting or remitting after 2 years and filing after 3 years the TDS return, the recipient how he can file updated return?
Some provision
has come now. Now
for you to
revise the return. Now this finance and 2023.
So his point is, Sir is asking this in a different fashion.
Yes.
Say, let's say for example, you look at bank, for any chance they never deducted TDS. So you never know unless it hits your savings account. If by for any chance it does not hit your savings account in the initial year, but after 3 or 4 years, they revise the TDS return and then there is an increase which is reflecting.
You have not offered it to income. That's the scenario.
Yes.
That is the scenario you're talking.
Yes.
We don't know that such item exists.
Yes, it will come. How to file updated return? It is not allowed under the law.
Updated return you can file for 2 years only.
Yeah.
There, if the time limit for assessment by the department is still open, then I think having noticed this, we should probably file an application under 119, say that we are aware of this only now, please permit us to file a revised return. Because you cannot file a revised return, you cannot file an updated return, system will not permit you to do anything, system will automatically close. If time limit for assessment is over, no problem, nobody can come and catch it. You can just, okay, fine, you have now deducted, I have enjoyed this income. So
someone will find out that it is an income escaped assessment, he will charge 80%.
That is why I am saying if the time limit for assessment is still open and you know that there is a probability of the department coming behind you and asking you to pay tax, 3 years probably, let's assume that 3 years has lapsed. So the extended period of 10 years can only be invoked. That will be invocable only if the income escaping assessment is 50 lakhs or more. If it is less than 50 lakhs, 3 years has lapsed, no problem. 3 years has not lapsed. If 3 years has lapsed, it's more than 50 lakhs. Then you make an application under 190. You say, I got to know of this only now. I cannot file revised return. I cannot file updated return.
No, you will come to know only after receiving the notice from the IT department. Otherwise, why would you go back and see 26 AS?
The recipient has already received 3 years back. Only the person who is supposed to deduct tax, he is complying now.
Sir,
by virtue of previous return only, it comes to on record.
Sir, ideally, an assessee is supposed to know what income he is getting.
He will not.
No, I completely understand.
Since there is no TDS, he has not offered as an income at all.
It has become a scenario where we are waiting for the department to update it in 26 AS. Ideally, I should know what should be there.
No, actually, instead of gross, net income has been offered. In that case, we will not know unless we check the 26 AS again.
In case of the panchayat, the contractors who are working for the government contractors, they will be working for the panchayat, and the panchayat till so many years they haven't filed any TDS return, and now all the panchayat has got the notice that you haven't filed any TDS return, and these assessors what they have did is they were know that the panchayat will never file the TDS return, so they haven't offered any income so far in their respective IT years. Now what this panchayat is doing, they are filing the TDS return from assessment year 1819 or 1920. So now what will happen? All these 26 years will get updated.
Till the date of filing, they have to wait even for the corporation to update their TDS.
Now these assessees have only one option, that sure they will get all the notice from the department for these escape this thing. So now what is the way out?
No way out.
No.
Madam, just I am asking a practical question. Now all the corporation contractors, they are discounting their bill with a finance company, for which these people are bearing the interest. The corporation has not released, they will be directly releasing the payment to the financier with whom I have discounted my bill. Who is going to deduct tax, when they are going to remit? It is a $1 million question as far as this 23-24 is concerned. Let us wait and see these corporation contractors, how to file the return in time.
So practically you will offer the income, because I am aware that there is an income which is going to come. The issue of TDS, let's say, which is coming subsequently, there is a challenge because...
Sir, I am telling you, even the Kalpakkam Atomic Power Station also, when they release the payment, then only they are deducting the tax. Here our corporation also will deduct tax only when they are releasing the payment to the financier, with whom I have deducted my bills.
Agreed, sir. The only issue will be is claiming a refund from the department.
Where is the money to pay the tax for the income which I have already offered?
Differential is a TDS only.
Can we proceed?
Yeah. Even I am telling you, the Kalpakkam Atomic Power Station, even for the security deposit also they are deducting tax. I don't know. Whatever money that is goes out, they deduct tax.
Sometimes people take conservative positions for TDS.
Even result amount, security deposit, whatever it is there, whenever they are releasing, they deduct tax.
And that's why we are there, no, to help the assistants. We are getting money, no. We should also help.
See, you are telling the department will look into it as an income, not as a security
That's why I am
deposit.
saying find out the matter, sir. So whatever you are saying here, go say to the department, find it out.
I am telling you lot of practical issues which the department people will not know. In one of the such cases, all night they are measuring the granite slabs. I have told the Joint Commissioner, your understanding of business itself is wrong. How do you say that? If there is a mold, if there is a crack, that product cannot be sold. They have added some 15 crores as additional stock which you have not declared.
Sir, some assessments which happen at the AO level, all of us know that we have seen lot of cases.
Many cases I can give hundreds of examples
Sir,
like
we
this.
have seen cases where 100 crore loan is added as income. But that's how the assessments happen sometimes. But in all those cases, we definitely have very good case before the appellate authority. We cannot go and fight with them because probably they don't have correct understanding. They have a misplaced understanding, they make some additions, we have to live with it.
I have explained 1 hour to the Joint Commissioner how the industry works. First you should understand the nature of business.
I understand, sir. In those cases, you have good case before the appellate levels.
So there is one interesting issue with regard to this non-resident tax deduction. See, now as the provision stands today, when a payment is made to a non-resident, you don't deduct TDS, 100% of the payment is disallowed. But when it comes to resident, 30% is disallowed. See, what has happened here is, see, when you look at the non-resident taxation, prior to 2015 or 14, prior to 2014, not all non-resident payments were subject to TDS disallowance. Only certain select payments were, with regard to residents, not all payments were subject to TDS disallowance. For non-residents, entirety of whatever you pay, if you don't deduct TDS, it is disallowed. For residents, it was only select payments. Now, it was in the case of an India-Japan transaction, where the assessees argued saying, see, when it comes to cross-border transaction, you don't look only the income tax law, you also look into the treaty which is governing that. If you look at the treaty, most of the treaties will have a non-discrimination clause. What that will say is, and this clause which I am now going to explain will be there in many treaties, that will say, don't discriminate. There should be no discrimination between tax deductible payments made to non-resident and resident when it comes to disallowance on account of non-deduction of TDS. This is the simple substance of what the clause will be there. So what the assessee tried to put forth in their see, as per the Indian income tax law, when I make the payment to non-resident, every payment I make when I don't deduct TDS, it is disallowed. But when it comes to resident, only certain select payments are disallowed. You apply the same logic. There shouldn't be no discrimination. If the payment in question is, say, interest, if that interest payment is also disallowed for resident when it comes to non-deduction, then I should be disallowed. Say if it is some other income, and that income when I pay is not disallowed when it comes to resident, you don't disallow it for me. Court read that provision that way and then said, when the law prevailing at that point in time was like that, only those payments which are otherwise disallowable for a resident, only those payments will be disallowed for a non-resident. This is a recent Delhi High Court judgment. Now if you look at the law, just see, you have a 100% disallowance for non-resident payments, only 30% disallowance for resident payments. Can you accept the same logic? Tomorrow when you make a payment to a non-resident, and if your treaty has a similar clause, can you put forth an argument before the assessing officer or the court and then say, when it comes to domestic transaction, my disallowance is restricted to 30%. No doubt, yes, I have defaulted. Restrict my disallowance to 30%, don't take it to 100%. We feel that going by this Delhi High Court judgment, and there is no, this judgment has not yet been stayed as of now. according to our knowledge, we can take this argument. This is something, an interesting judgment which came very recently. Like, when it comes to non-resident transaction, you can have this thing in mind. The judgment is Mitsubishi Corporation Private Limited, though it was in a different context, but now you have the same disparity, just that in the ambit of the quantum of disallowance.
Previously, I think it was 100%, right? For 1 year.
Yeah.
40 years, and now salaries are excluded, so it's not there.
Next option is 43B. Now, we are all aware that there are certain deductions that are available only upon actual payment. Actual payment, you have to actually pay. By when you have to pay? In general, you have to pay on or before your due date of filing the return of income. If you don't pay, you cannot claim deduction in that year. Does not mean you cannot claim at all. Subsequently, whenever you are paying, you can claim the deduction. Now, a recent addition to this a bundle of items that are covered under 43B is any amounts payable to a micro or small enterprise, not a medium enterprise, micro or a small enterprise. If you are liable to pay any amount to them, and the due date for such payment has lapsed, as on 31st March you have not paid, then you will not get deduction for that particular expenditure. Even if you pay that expenditure within the due date of filing return of income, you will not get it. So, for this particular line item, the threshold is pay on or before the end of the financial year.
But it is allowed if there is an agreement between the supplier and the recipient. Today, Taxman has come up with a ready reckoner for MSME Act. Please go through that.
Yes, sir. Yeah. Now, section 15 of the MSME Act will talk about the due date. It will say that if there is no agreement, it's 15 days. If there is an agreement, then as per that agreement. But in any case, such as per the agreement, but in any case, such agreement cannot exceed 45 days. The idea for the act is to protect this MSME sector. If it is left to the whims and fancies of people to agree on whatever timelines they want, large players can easily tell them that I will pay only after 90 days. And then micro or small enterprises will have no leeway. If a large giant, if a 10,000 crore company says, I will give after 90 days only, if you want to do business with me, what do they have to say? They cannot say anything. The act is to protect the interests of this sector. Therefore, they say that if you have agreed on a due date, that due date. But in any case, that cannot exceed 45 days. They clearly want payments to this small business people to go within 45 days. Your rights are definitely that agreement has to be factored, but in any case that cannot exceed 45 days. So suppose you have availed some services or purchased some goods from a small enterprise company, an enterprise falling within this bracket on 21st March, and your agreed period is 30 days, then going strictly by the terminology used, phraseology used in 43B, for that year disallowance will not attract it because the due date has not lapsed as yet. However,
transactions between two micro enterprises
covered. The 43B disallowance is not excluded for a micro or small enterprise.
The people are trying to argue that between micro it does not say anywhere, it only says a person. So who is this person? Is it also a micro or is it some other?
Any person, the idea is to protect the recipient who is a micro or small enterprise. Even if the payer is another micro or small enterprise, there is no relaxation.
Even those who have issued check as on 31st, till now it is not encashed. It is clearly mentioned in the Taxman ready reckoner for MSME. They have brought in lot of practical issues which a chartered accountant, before putting his signature, he has to verify many things in this case. It is very difficult proportion to identify and to certify.
So there can be scenarios where we actually practically faced a question from one of our clients where the situation was that the purchase was backed by a letter of credit, and it is an irrevocable and unconditional letter of credit, which means that once the shipment or once the goods have been delivered, then the enterprise can go to the banker, give the relevant documents and get his money. And the bank will have no reason to say that I will not give you. It's an irrevocable and unconditional. In those circumstances, probably we can take a position that the payment has been ensured. I mean, in the sense that if let us say we have given a check, we have actually given the check, not dated, we have actually given the check, and the check has not been presented for 10 days, 15 days, etc., that is not in our control. Then in that case, the homicide payment has gone. Similarly, in this case of an NC, where it is an unconditional irrevocable NC, then and the payment can be presented on day one and money can be obtained. And in that case also, we can take a position that 43B disallowance should not get attracted. This is a new provision, sir. So lot of people may have practical questions on that. So we'll be happy to take them. For us also it is new. We are also encountering a lot of practical circumstances and taking positions based on facts and circumstances. So if you have any specific questions on that.
The only thing, the MSME are not getting to get a certificate as a registered with the central government, MSME, then we will come to know that it is MSME.
Then registration I think is mandatory. You have to register on the portal. Either the invoice should contain his number. You can go and check also and keep. Or you should ask him for it.
Then only I can ensure that.
That groundwork has to be done by the client.
How if the clients are facing this, none of them are giving the registration?
No, we cannot take into account what all declaration our client is giving that we are in the process of obtaining the MSME certificate. We have not yet identified the MSME suppliers and all. It will not help as a chartered accountant for our certification.
One more ground reality, it's MSME selecting to say that I am the MSME because the company has to make the payment 40 days. So generally they have 60 days, 90 days payment terms like that. So that the buyer who is going to buy the product MSME will be discouraged to buy the product before they are not disclosed with the PR and MSME.
So are we a default even in that case?
Sir, of late, what is happening is onboarding every vendor company has to.
We should have a detailed discussion on this.
What is happening?
We should have a detailed discussion.
Suppose
is mandating.
Suppose I'm asking, he says that I'm not MSME. So I don't know. So I will onboard him as a normal vendor.
Don't need to check that he is not an MSME.
Even today, clients are issuing check date at 31st March.
Bank details of all your vendors, etc. They will be able to. It could have some teething trouble for the department to,
Even for department, it will be difficult.
Ask permission additional details.
It's a mandate, sir. The provision is a mandate.
Tomorrow the income tax will come back on how that means tomorrow is coming as MSME.
Sometime down the years, it will all become seamless. Till such time, department also, for them also, it's a problem. Cannot be.
Probable after 2 years or 3 years will come and say there is a disallowance because you not calculate the 40 days, 15 days. So it's a disallowance.
There is also a report that a lot of MSMEs has been surrendered.
Yes.
That is
They are
because
surrendered.
they are not getting contracts.
Yes.
Not to attract this.
Only government want to push that MSME.
But the big companies can lobby.
Correct.
At the point of surrender, MSME disallowance will come and after they surrendered the MSME status.
We should have a separate session for this.
Actually, MSMEs are also covered against this provision.
In this taxman radio which we have not caught, they have raised so many questions and answers. If you follow that, we cannot settle it.
Presumptive taxation. We are covering because we wanted to highlight a particular issue. Now, we are all aware presumptive taxation for business is 8% or 6% of the turnover, as the case may be. For professionals, 60%. Now, mostly what all SSCs do is take their turnover, apply 6%, 8%, for professionals apply 50% pay tax. But does the law say that? Does the law say that, listen, I don't want to spend time on small SSCs SSC, therefore 6%, 8%, whatever you declare, I'll accept. That is the amount which is deemed to be your income, and you pay tax on that. Straightforward. You also keep also. Provision is not worded like that. Provision says 6% or 8% or any such higher amount as may be claimed by the SSC. Now, what is meant by claimed by the SSC? That expression is not defined or is not interpreted anywhere. Suppose tomorrow department asks you for your books of accounts. You give bank statement, every transaction is in your bank account. And then they say that your credits are so much, your debits are so much, these are all your expenses. You have said 50% is your income, 75% is what you have paid, 75% I will tax. Do you think department is right? You have opted for 4488. We are all chartered accountants. We have opted for 4488. We have got 50 lakhs income, 50%, 25 lakhs we have paid tax. Department looks into our bank statements, looks into all our documents and then says, listen, I have seen it completely. You have not yet 25 lakhs, you have got 40 lakhs. 10 lakhs is your expenditure. You should have offered 40 lakhs to tax. Pay tax on 40 lakhs. If the department says that, do you think department will be right?
No.
Why, sir?
I choose the very offered.
Yes, department is right. As per the section department. See, they said 50% or higher income, whichever is higher.
All of you who said no, why do you think no, sir?
Three provisions pay 8% to 6%. So I'm going by the provisions. That's all. Even though a higher amount, why I should offer? Because I'm going by the provisions of that's all.
If they ask for assessee is working, the income is more, but he has offered the 8%.
Correct, sir, because of the provision is given now.
8% is the minimum. The actual income is more, that should be offered.
Sir, books of accounts, that provision does not say don't maintain books of accounts. If you come to 44AA, because of your turnover, you might be required to maintain books of accounts. Because if you look at the provision 44AA, it will say if your that is for your presumptive taxation. That is different from the limits maintained for maintenance of books of accounts. If you are 1,20,000, if your income exceeds or your sales exceeds 10 lakhs, you will be required to maintain books of accounts. Tomorrow the department can initiate proceedings for non-maintenance of books of accounts. Now after they see your books of accounts and they find out that
is exempted, sir, for 44ADA. See, where you may go for presumptive, they cannot insist on maintenance of books of accounts.
There is no specific.
Where the problem comes is, that person withdraws the amount and spend it as cash or keep it as a cash, then there is escape.
There is no exemption, sir, for maintenance. Just because you opt 44ADA, you don't need to maintain books of accounts. Exemption is not going there. We are interpreting for our own benefit. Law is not giving an exemption. You look at 44ADA, you look at 44AA. 44ADA nowhere says if you opt for this provision, don't maintain books of accounts. No. We can read 44ADA fully for you. There is no provision in 44ADA which says that if you are paying 50%, don't maintain books of accounts. I understand your concern, saying the whole purpose is to make.
44ADA is notwithstanding anything contained in 28 to 43C, not 44A. There is no exclusion for 44.
Books of accounts is flowing from 44A. See, at the end of the day, the whole purpose is to make sure that you are at ease. But
there is a box in the right here also.
If you think yes, then it will ask you for a lot of details. Therefore, we say no. Not because the law says no.
No, but even in ADA cases, you have to treat yes if it is applicable.
yes, that's what we are saying. It's not like just because you are ADA, you should not give at all. We are giving it because we feel like it.
Sir, when they say mix of accounts, what I understand that you have to maintain the sales feature, you have to maintain the packet quantity. That's all. We did not maintain purchase, wages, etc. That is what the provision says. You have to maintain what is your source of income, whatever declaring that for sales register. What was the amount collected? It was back account, that's all.
Yeah, there is one small list of items given for.
That is what, it is not the necessity to make a full books of accounts, then what is the provision?
That's what they say. Suppose they say you have to maintain books of accounts. Say books of accounts I am maintaining in Excel. All bank statement is the only books of accounts because all my transactions are to bank account. Then you give that bank account. Department looks at that bank account, says you are saying you want 24 lakhs only, but you have spent only 10 lakhs in the whole.
No, spent is not a material.
No, your profit is more than 25 lakhs, more than 50%.
Definitely, madam, my profit is more than that, more than 6%, more than 8%. Since I am choosing this provision, I am made, for or not, we not making the books.
You are not due to think like that. That's the problem. From beginning, we have been lectured saying presumptive is a benefit. That's the problem.
So there is no exemption from maintaining books of accounts. If 44A applies, you have to maintain books of accounts. 44ADA says
So every time we have to calculate and declare whichever is higher.
so far things have been going on in a particular way. If tomorrow
Also, nobody is bothered to check so far.
No, department has not taken that stand, no, so far with your.
No, like HRA came. For a long time it was going on.
Now it is.
Now department realized. So slowly questions
So
are
now I saw the salary notices. They are asking you to provide basis for the deductions claim. Till now, none of the salary employees have got it. That's what I think.
So this is, we may think department is not raising because they are not aware. Department may not be raising them because they may be doing a cost benefit analysis. The moment cost benefit analysis comes out to be positive,
With respect to this 44 ADA, what are those services for which you can come or which are covered under 44 ADA? All professional services?
After section 44, whatever specified professionals.
Accountancy, legal services, interior decorators. There are some 6 specific services. Architect.
medical, legal.
Because many of these information technology consultancy services which they render from home, right? That goes way beyond this and where is it? See, that's a very general term that is used there, technical consultancy services. Can you bring all these things under that? The software developer services and
somebody objects, you can bring.
Exactly.
So unless the department catches, we can do.
So YouTube revenue.
Sorry? How is it? 6%, yeah, not 3%. What is that you are doing to analyze that? You are not doing any consultancy to you. Then
the first few you can define, legal, accountancy, architecture and those. I am talking about all these services which can, everything can be grouped under technical consultancy services.
You are having a YouTube channel where you are going to educate people about different laws. Doing a food review or just a blog of whatever places you have gone.
Taking classes.
see, I think very points on how do you want it.
You have these marketing consultants, they tell you what are the social platforms that you have to use, get hold of this social media influencers and stuff. They are actually render consultancy services. Can you bring it under 44 is the question.
There is no technical consultancy in there. It's not application of any.
As ma'am rightly said, until the department finds out, you
No,
can
in
still.
case of an IT professional, he may be doing some coding, he may be applying whatever he has learned somewhere. That can qualify as technical.
So anything related to knowledge can be classified as technical. You have to, can we take that interpretation?
Like an application
Application of some knowledge.
Excuse me, how fees are both mixing package? As a mixing package, if you are learning fees, that's not, I think, very hard to
Because taxes are 10%.
Sorry? Teaching is notified the teaching is notified you are teaching.
Some sports teaching, all those things are.
On the previous point of offering a higher income than 8% or 50%. No, the point was, small words. The point is, if I have to say, offer the correct amount, like say, I earned something, minus 60%, and if I offer 60%, then what's the point of presumptive? I might as well take all the other benefits and go for the normal thing. Correct?
Nobody is stopping us.
No, then section is presumptive is there to redeem some benefits.
So ease of business.
See, the problem is all we are talking here. Yes, correct. That's departure, intent, everything. The problem is the letter of was not changed. See, government will come with a policy. This is the intent, this is the purpose. At the end of the day, that is not translated into the letter of law. There becomes a difficulty. We can still argue. See, we will still argue saying, at the end of the day, the purpose is to simplify the process. And there is specific provision which says if you want to claim a lower profit, maintain books of accounts and get audited. So, that's it in this, you have taken an argument. You are not saying that it's not free from litigation.
When you go down from less than 6%, less than 8%, you can insist on the reserve amount.
The law said 6% or 8% is deemed to be your profit. If it is lower, you maintain books of accounts. But they are not 6%, 8%, they don't want to give the scenario where you are earning more. But if it is such a high amount, that's the way they do. That's why the problem is.
But now that is.
Yeah, that should be possible.
We can ask for deductions, we should be prepared for disallowance.
I can also look at
that is independent. Even if you have presented that will apply.
we spend for money.
So, that to me, for the ADA, I'm offering 10%, okay, assuming 10% interest. But that can be exactly that is positive.
If you say you're going with 4480 and offering interest,
That's what I'm saying. Because you are saying that 6 and 8% total interest are no exemptions are not correct. No. Suppose I'm having the same 4480, 10% interest. 10%.
Then you can take exemption.
10% I can take all the exemptions.
Yeah.
Will fall in each year.
It's a separate special charging provision. See, you can still guarantee in a business or whatever it is, but it's a special provision.
But we have to fall into some state.
most of the cases is income from other sources.
Because the moment you say it's business, there are rulings which say that the source is defined, no audition under 69, because those are unexplained. So it will fall under.
Have all those additions because something department is not, you are not able to explain. You bought a house, you are not able to explain where you got the money. You told it was business, it was straightforward.
On the turn of other losses. Raising the exclusion limit will apply.
Yeah, that will happen.
Yeah, correct. That happens. You cannot claim any expenses. And you cannot claim any income based. Any other specific questions that you may have, even though we may not have covered it, if you have any points that you probably wanted us to clarify in that session. And see, the time is quite short. As I said, this is a vast topic. If we were to meet every day for the next 5-6 days we won't be covering even 50-60%. That's the kind of issues that are there, and that's the kind of nuances that this topic has to offer, and the precedents that have evolved over years. So if you have any specific questions, we can try and address them.
Another question, if possible, please share this PPT to all the participants.
Definitely, sir.
It goes through completely, so that because we couldn't able to see so many PPTs, what we prepared due to time constraints.
We will share the presentation, sir. Our coordinates are also there. You can see the email ID, and any questions that you might have, you can please drop an email to us. We'll be happy to talk to you and discuss that. Thank you so much. It was a pleasure interacting with all of you, and thank you for making the session quite interactive. We learned a lot in the process, during the course of preparation and also in the course of interaction with thank you so much for staying back and listening to us. Thanks a lot. We look forward to meeting all of you more than more.
Thank you very much, Anna, and the speakers really, we are kind enough to have these two speakers today, and we know about this topic is vast enough. If we have 1 week time also, it is not enough to complete this chapter. But at the same time, our intention is to touch upon the topics, that is the back to basics concept. So in that concept only we have introduced, we have taken the initiative of having this kind of program. And today I am really happy to see so many members. The first day the members was less, it's okay, but today the hall is full, and we expect the same kind of cooperation for all our programs. And soon after completing this back to basics on income tax, we are planning to have on corporate tax and Companies Act, and later GST. So one or the other acts we will be touching on. So throughout the year we are planning to have this back to basics. So I need your cooperation, support, and if you wish to have any other programs, if you want to have at SIRC, please let us know. We are all here to serve you, to have such kind of programs. And as ma'am said, because of the time constraint, the coverage was little bit less. So, but still, the PPTs are there. Definitely, we will share the PPTs with you people. And if you have any queries also, as they only agreed to share your queries, you can share your queries. And as resource persons are so generous and kind enough to help us and to answer the queries of all the members. Thank you very much, ma'am. Thank you.
Be back and speaking at SIRC. We remember the days when we were students.
Oh, thank you.
It's always a great feeling to come back to this place again. It's like, going to your mother's house.
Thank you.
Thank you so much for your
And one more initiative of our team of this year is to have at least one young member and women member as a resource person to have for this event. At least in a month, at least one woman member or one young member. So I think two of them today we have. It is not only gender bias kind of thing or other things. They are also talented, but somehow, somewhere I feel they hesitate to come out and show their talent and share their knowledge. So at least this kind of an opportunity will help them to come out, and for us also it will be say a great help and for some satisfaction. Okay, we are also giving an opportunity to other people also. It is not that the routine person whomever is coming again and again, not concentrating on it. So many other people also there. And I request all you people, if anyone is there and if you are also interested in any kind of taking classes or sessions here, please let us know. We have circulated on Google form. Because we are planning to have so many other events also. The one such kind of thing is about train and learn program. We go to the colleges and we train the students, because as you know, getting the articles is very much difficult. It is not about getting the articles, but at the same time we would like to train the youngsters and make them efficient to work in the office, and later we can take them on an empanelment basis to our CA firms. So it's a win-win situation for both, for our students and for the members, and at the same time it's a brand building activity from ICA. So for that we are searching, we are looking for the volunteers or the members who can help us to go as a faculty and and for that everything as per the requirement is there, those things and all will be there. So I request everyone, and volunteers also we are looking for other kind of institute activities. We are looking for volunteers also. Please, if you are anyone is interested, let us know, and we will take it accordingly and we will discuss it later. Thank you very much. Now I request come forward to present a moment to our speaker. This also we have changed. Go green concept. And we are coming with a beautiful memento. Right now we didn't get that one, so for the time being we have shifted to this memento. That also would be much more useful. Sir, come forward. Senior member to young member. This is what hand holding. Taxation,